at the end of the day, you're not going to hit all-time highs day after day after day.
Investors should still expect that there can be some volatility.
Conditions have become increasingly fragile.
We have nice earnings growth, but it's being pushed by Mag 7.
We are going to see a broadening out of the market. I think we're heading into Goldilocks.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
Live from New York City this morning. Good morning, good morning. For our audience worldwide, Bloomberg Surveillance starts right now. Coming into Wednesday, looking for stability. A tech-fueled equity market rally morphing into a tech-fueled sell-off. As Democrats are posting big wins in key races across the country, the next test for White House policy is in the Supreme Court. A hearing on tariffs later on today.
We're not going to learn necessarily anything definitive today, but make no mistake, this hearing and this potential Supreme Court ruling has the potential to be transformative, both for Donald Trump's policies, but also for the market. There is an expectation that the revenue coming from tariffs can offset some of the expenditures that will really come to the fore early next year that's been supporting the bond market. If that is overturned, a big question of how the market will respond.
And a big question is if the Commerce Department, the Treasury can refund all of this money in terms of the tariff revenue, but the administration will go about collecting tariff revenue in other ways, 232s, 301s. The big issue here is for our day and age, this is the most critical Supreme Court moment in terms of presidential economic power. And this administration is trying to say, actually, it's not economic power. This is about national security.
In many ways, it plays into the debate at the moment, affordability. The mayoral candidate, Zohran Mamdani, now mayor-elect, has been so on message over the last several months in this campaign. He takes everything back to affordability, and a cost of living. And that's the blueprint for electoral politics in this country for the next 18 months and beyond.
A lot of people can say a lot of things, but what he did was promise something, and a lot of other Democrats hadn't been. Previously, they had just been the anti-Trump. He came back to the same themes that President Trump ran on, which is affordability, cost of living, cost of housing. So here's the question. How does that get manufactured, and how does President Trump message that today in a call that he's planning with congressional Republicans, where he goes back to them? Does he say, look, we need to double down on this? Or does he say, you need to fight harder, we're going to keep the government shut, it's the longest shutdown on record, and you know what, let's keep going because we don't want to make concessions?
He's identified the right problems. Has he got the solutions?
Well, this is the problem right now, and it's not just affordability in New York. Affordability is how you have Mikey Sherrill winning in New Jersey. She talked about the fact that electricity prices in New Jersey are now in the double digits, and she said, I'm going to be the anti-Trump, where her counterpart, Jack Ciattarelli, was talking about how Trump at the moment deserved an A grade. Same thing in Virginia. These are two governors where likely they were going to win. There are more Democrats in these states than there are Republicans. The margin by plus 10-point margins. And how can we not talk about California this morning? Prop 50 passing. This is a springboard for Gavin Newsom for 2028.
You've got to get into the market moves as well. Equity futures pulling back again this morning by 0.4%. Big sell-off yesterday for big tech. High yield spreads wider over the past 5 sessions as well, Bramo. Look, the moves are notable. The levels are still okay for high yield, but it gets your attention.
Especially given the fact that you're starting to see an increasing number of potential downgrades from investment grade to speculative grade. There is a sense that there are cracks forming. How deep those cracks are, whether that is a huge red flag, remains to be seen. Nonetheless, what did we see underperform the most yesterday? Non-profitable tech. There is a real question where people need to show me, not necessarily just say AI 5 times. And right now, people are seeing the ones that are out there that are not able to make those bills or are not able to grow their revenues as fast as expected, punished roundly.
Big hour coming up on this program. We'll catch up with Kathryn Dawson of NewEdge Wealth as the stock sell-off takes another leg lower. Jessica Taylor of the Cook Political Report as Democrats sweep key races. And Nazak Nikakhtar of Wiley with the fate of global trade heading to the Supreme Court. We begin this hour with our top story. The capital of finance electing a socialist.
You have dared to reach for something greater. Tonight, against all odds, we have grasped it. The future is in our hands.
Zohran Mamdani winning more than 50% of the vote after vowing to bring major changes to the global capital of finance. Bloomberg's Miles Miller joins us now outside City Hall. Miles Miller, good morning to you, sir. A big win for Mamdani.
Yeah, that's right. It wasn't just a win. It was very much a statement. And what he calls a mandate. This is a person who campaigned on a message of affordability, right? Free buses, freezing the rent, and of course, universal child care. How those things get pushed through or work in City Hall will be one thing, but it is very clear that there was a big contingent of New Yorkers who decided that he was the right person for the job. You know, getting almost 1 million votes and reaching 50% of the vote is no easy task here. It is the highest voter turnout in more than 4 decades here in this city. What we know is that he pulled this off with a truly grassroots coalition. We are hearing people who said that he went all the way out to the Rockaways. He was on Staten Island, really trying to get his message across. And what we know is that he's going to have to work with the business community, right? As you said, the really capital of capitalism here, big banks based here, a burgeoning AI and tech sector here. And so he knows that his transition team really has to focus on what makes New York City tick. And we heard from Wall Street leaders last night about how they plan to work with him on these issues. But of course, this was a grueling campaign. Andrew Cuomo was looking to make a splash after losing in the primary, going after him on the message of public safety, going after him and saying that he's only 34 and had no experience. But New Yorkers seem not to care about that, the affordability message winning true. And something we spoke about yesterday, that was a message that Donald Trump won on just last year. And what is very interesting, Mamdani has said, is that he's willing to work with Trump on affordability, but he's also willing to be a fighter against Trump if he does what he said he would do just 2 days ago, which is pull money from New York City because he says that Mamdani is a socialist.
Miles, appreciate the update. Miles Miller there, tracking the story for us on Bloomberg TV and on Bloomberg Radio throughout this morning. What's the first move for Mamdani in the next few weeks, the next several months? What's the first move for the President of the United States?
Well, for Mamdani, it has to be to keep Jessica Tisch. He has said plans on keeping her as the New York Police Department commissioner. Does she accept? How long does she stay on? That will assuage the concerns of the business community because public safety for them is number one to make sure they continue to retain and attract the best talent.
We've got a market story to stay on top of as well. Equity futures down by about 1/3 on the S&P 500. Here's the view on Wall Street. Cameron Dawson of NewEdge Wealth writing, we see potential for the mount up to barrel on into year end, but see cracks under the surface that could make the market more fragile to start 26. Cameron joins us now for more. Good morning, Cameron.
Good morning.
Are you long real estate in Florida? That's a joke, don't answer. Let's get to the cracks under the surface. What are the cracks under the surface?
The first one is no. And the second one is we've certainly seen a deterioration in breadth over the course of the last month or so. You've seen this market get ever more narrow. You have 60% of the names within the S&P 500 not trading above their 50-day moving average. And that was brewing even as we were hitting all-time highs last week. We also saw a big surge in very speculative parts of the market over the course of the last 2 months that was simply unsustainable. Even the SOX was up 30% over the course of September and October. So we should not be surprised that we are seeing volatility. That is the nature of equity markets. We're only 2% off of all-time highs. You're still very much in an uptrend, but you have to appreciate the fact that we've had this melt up, and it just increases the probability that you have some chop and churn as you digest these massive moves.
Is there any broader lesson, though, from what we saw yesterday? And you might just say no, but there is a sense that you did see the rest of the universe actually outperform, and you saw more gainers than you did losers, even with the overall index falling. A reversal of that very narrow breadth that we had been seeing. Is this the beginning of something broader?
Finally, we can celebrate diversification, right? Because over the last couple of months, we've been in a world where you could only own just a small handful of names in order to be able to outperform. But days like yesterday are a great reminder of why diversification works and why valuation discipline works. Valuations are a tough one because they're not a great timing tool. However, they do matter when you get a catalyst, and they amplify moves to the downside. So when you look at things like non-profitable tech having rallied 37% this year, non-revenue NASDAQ companies up 67% this year. These are just areas that you've seen big, huge parabolic moves higher. And what you typically see is after a straight line up, you often do see in those areas a straight line down.
The only issue is it doesn't seem like this is fundamentally driven. We saw earnings from Palantir that blew out expectations. AMD came out. They beat I saw the write-ups trying to find a reason for why the shares sold off. It was, tepid at best. I mean, they did a good job. Congratulations on trying to make an effort to make a narrative here. But they did a great quarter. So I don't understand exactly what the fundamental concern is that could drive these shares lower.
Heavy is the head that wears the high bar. At the end of the day, you can have beats and raises, but if the buy side numbers are higher, positioning is already very crowded. Who's the incremental buyer? And so that's why we have to pay very close attention when stock or asset prices in general don't move in the direction that the news would suggest. That usually is a sign that positioning is very crowded and people have already priced in most of the good news. You look at something like the SOX, it's trading at 28 times forward earnings. Remember, semiconductors are very, very cyclical companies. If you start putting peak on peak earnings, so peak valuations on peak earnings, that usually is a recipe for underperformance because you are putting such a high valuation on earnings that are unlikely to be extrapolated further into the future.
We've seen some pushback. Meta last week. We've seen it as well this week with Palantir, again with AMD. It's one of those markets, Bramo. You talked about AMD. It's not about beating the average estimate. It's about beating the top estimate. And I think that speaks to the AMD story this morning.
The idea that they beat revenues by 9.6%. People are expecting 9.9% at the very highest end. Even the average was 9.2%. Speaks exactly to what you're talking about. I just wonder if there is this bigger story here about a rotation away from big tech to the rest of the universe, how predicated that is on some sort of rate cut, or whether this really is a reacceleration in the economy that we can't really track because we don't get data.
The airlines had a dreadful day yesterday as well. It's not just big tech. I'm seeing pockets of weakness elsewhere. The guidance I'm getting from the restaurant business as well, Chipotle and others too, are pointing to an economy that's maybe not so great. What do you see?
Cardboard boxes. Cardboard boxes are having one of the worst volumes since 2015 for this time of year. And that is raising concerns about the strength going into holiday season. And there's a fair point that you have seen this market diverge from the real economy. If you look at over the course of the long term, usually freight expenditures are very closely tracked by the S&P 500, but they've diverged since the pandemic, which speaks to the intangible nature of this market. However, at the end of the day, we still do all breathe the same economic air. All of the Mag 7 are still cyclical businesses that rely on the U.S. economy remaining strong, whether we're thinking about advertising or high-end consumer goods. So if the U.S. economy really is weakening, we should not expect that all of these companies will remain immune.
This is the point of tension that's persisted all year. We'll get the ADP jobs report later. It's all we've got. We don't have the payrolls report anymore. I don't know when we're going to get that. But the point of tension is we've opened up a gap between equity market performance and employment this year. And a question we keep going back to is how much longer can that persist?
And is it a feature, not a bug? Is it the idea that the acceleration of AI comes without this sort of commensurate employment? Or is this something that eventually will lead to that employment picture? I think that the fast casual retailers, to me, the fast casual restaurants, those are a key tell. How much is that a universe of its own? How much of this really is an indication of consumers pushing back?
Carver, another one cutting its full-year sales growth targets in the last 24 hours. I thought you were permanently long Florida real estate, being from Florida. You know?
My family's still there, but
there you go. All right, it doesn't have to be about politics. Cam, it's good to see you. Thank you. Kathryn Dawson of NewEdge Wealth. Of course, it is about politics. Let's get you an update on stories elsewhere this morning with your Bloomberg brief. Let's cross over to Yahara for more. Hey, Yahara.
Hi, John. Voters in California passed Proposition 50 to redraw the state's congressional map before the midterms. With 71% of the votes counted, nearly 64% of voters approved the ballot measure that could flip up to 5 Republican-held House seats to Democrats next year. Meanwhile, the government shutdown has reached a new milestone. It is now the longest in U.S. history at day 36. Senate Majority Leader John Thune says he hopes this will be the week they can negotiate an end to the impasse. But even if they do, they'll face another funding fight. The stopgap spending bill the House passed in September expires in a little more than 2 weeks. And Amazon has sent a cease and desist letter to Perplexity demanding that the search startup stop allowing its AI browser agent Comet to make purchases online for users. Amazon accuses Perplexity of committing computer fraud by failing to disclose when its AI agent is shopping on a user's behalf. Perplexity says Amazon is bullying a smaller competitor. That's your Bloomberg brief. John.
Yahara, thank you. Thank you very much. More from Yahara later this hour. Up next on the program, a Democratic sweep.
New York, tonight you have delivered a mandate for change.
In 2025, Virginia chose pragmatism over partisanship. So New Jersey, the future is now.
That conversation up next with Jessica Taylor of the Cook Political Report from New York City this morning. Good morning. Two days of gains on the S&P 500 running into a day of losses. The losses carry on this morning. We're down 1/3% on the S&P. On the Nasdaq 100 down by 0.5. Under surveillance this morning, looking at the politics, a Democratic sweep.
New York, tonight you have delivered a mandate for change. A mandate for a new kind of politics. A mandate for a city we can afford.
In 2025, Virginia chose pragmatism over partisanship. So New Jersey, the future is now. Roll up your sleeves, let your passion flow.
So here's the latest this morning. Democrats sweeping 3 major local elections from New York City to New Jersey and Virginia by a wider than expected margin. Joining us now is Bloomberg's Tyler Kendall. Good morning, Tyler.
Hey, John. Good morning. Well, the Democratic wins last night will no doubt bolster a party that's been grappling with a way to counter Republicans' grip here in Washington. And while New York elected a progressive Mamdani, we did say 2 moderate Democrats clinched the gubernatorial elections in Virginia and New Jersey. But the common theme among all of these elections was a focus on pocketbook issues and the economy, really the same issues that helped propel President Trump to the White House. But with consumer sentiment now at a 5-month low, early exit polls from the Associated Press showed that 6 in 10 voters in Virginia and New Jersey say that they are either angry or dissatisfied with the current state of the country. Importantly, President Trump lost both of these states in 2024, but he had made significant inroads compared to the numbers he polled in 2020. That's leading some strategists to say that this perhaps could show the future limitations of having President Trump not on the ballot, despite him weighing in on all of these races. One thing's for sure, last night's results will no doubt inform how both parties are going to comb through the results to inform their midterm election strategy, not just on issue, but also on where they're going to pour their resources into. Because, John, we'd be remiss if we didn't mention that Democratic Governor Gavin Newsom won his effort when it comes to the redistricting fight, which could give Democrats 5 new seats in that state. But it's all in a bid to counter Republicans' own efforts that are happening across the country.
Tyler Kendall with the latest. Tyler, thank you. We'll catch up with Tyler later on this morning. To build on this story, Jessica Taylor of the Cook Political Report writing the following. The losses for Republicans across the board and surging Democratic enthusiasm were the most concrete signs yet that a backlash to Trump akin to 2018 is brewing. Jessica joins us now for more. Jessica, welcome back to the programme. Let's just take stock of what we saw in the last 24 hours. How does that stack up with what we saw 12 months ago?
I mean, it's just a complete reversal and a complete rebuke of Trump in his first term. I mean, we expected Democrats to have a good night. They were favored. And I mean, certainly I kind of put the New York City result aside because New York City is one of the bluest cities in the country. So I think that doesn't tell us as much. To me, it's Virginia and New Jersey. These are states that Trump made gains in. He won both by about 6 points, and that was a massive improvement from his 2020 results. But the fact that that we expected, a double-digit victory in both of these contests. Abigail Spanberger right now is winning by 15 points. Polls showed somewhere around like 8 to 12. New Jersey, especially, this was a race that was in single digits in polling, even low single digits at some point. And Mikey Sherrill is winning by 13 points. One of the biggest trends that we saw this time last year was that Trump made gains in heavily Hispanic areas. When I'm looking at, one of the most Hispanic precincts, for instance, in Virginia, Spanberger saw a 22-point swing in her direction. So this new coalition that Trump felt like he had built on more diverse voters, that was completely obliterated last night.
Jessica, I'm glad you brought that up because Passaic County, I'm looking at a plus 15 margin for Mikey Sherrill. And this is a county that Trump won last year. What do Republicans need to do ahead of the midterms, seeing these kind of results and these type of margins?
Well, I think it's two issues. Overall, I mean, the Republicans' numbers in both of these were pretty much in line with Trump's approval ratings, which were in the low 40s. And typically in midterm elections, we see that Republican candidates get about that. So if that presages what we see in 2026, this could be a blowout. And then, of course, we look at the House of Representatives and some of this mid-decade redistricting that's been going on in Texas, for instance. They were banking on better Hispanic turnout in places like South Texas. So some of those districts that they redrew to be favorable to them, that might not be the case. They might have just doomed themselves in some of those. It's a little too early to tell, but I think it tells us two things. We saw in exit polling that people are not happy with the way that Trump is going about enforcement immigration with ICE. And then it's the economy. It just goes down to that people are very unhappy with the direction of the country. And when you do not have Trump on the ballot, if you want to send a message that you are upset at his policies and the direction he's taking the country, the only way you have to voice that is to vote for the opposing party.
It feels like the individuals that won did focus on affordability, something Trump did a year ago, and they didn't focus on making this about Donald Trump. So is that the blueprint? Actually speak to voters where they are in terms of their economic concerns?
I think you're absolutely right. We saw in Virginia, for instance, where I am, Abigail Spanberger, she did not run an anti-Trump campaign. She talked about jobs and the economy. And listen, this race was particularly roiled by, it has one of the highest concentration of federal workers. So it wasn't just, the government shutdown overly affected people here, but just the continued assault on federal workers and trying to cut the DOGE and trying to cut workers and different things. In New Jersey, Mikey Sherrill focused on high utility bills and different things. So again, but in both races, the Republican candidates did not do anything to distance themselves from Trump. Trump wouldn't allow that, really. He demands such fealty. So that's really the quandary he's putting some of these Republican candidates in come 2026.
Jessica, did these elections that we saw yesterday throughout the Northeast and California make it that we'll get a sooner resolution to the government shutdown, or do you think that it's just going to harden the lines?
It does seem like we're seeing movement. I think that there is talk now of obviously the CR that's on the table would be just through the 21st of this month. So I think they're looking at something through either the end of the year or January. We're already seeing movement with some more moderate Democrats. I think that Democrats now can say, look, not just that we want to move on affordability and different things, but when they're talking about the Obamacare subsidies and things, it just comes down to cost. And I think all of that folds into that. So I do think we will see some movement, but the next few days here are in how both parties react to the results and maybe don't overread into them or overreact could be really critical.
Jessica Taylor of the Cook Political Report. Jessica, thanks for your time to break down these numbers. Big changes in the last 24 hours compared to what we saw 12 months ago. Lisa, we talked a lot about what this could mean for the midterms. I think we need to talk more about what it could mean for the Democratic Party and the leadership into the next general election, and which ideas are winning out at the moment in that party.
Right now you have both spectrums. That's the interesting thing. You had the New Jersey and the Virginia races, and the governors that won there who were Democrats were very much centrists. And then you have Zoran Mamdani, who is a socialist Democrat. How does this shake out in terms of what happens in the midterms remains to be seen. Nonetheless, that's the reason why Proposition 50 might be most interesting, because it definitely gives California an upper hand in that race.
For the party writ large, Gavin Newsom is now going to be seen as someone who delivered for the entire party nationally. He's going to use Prop 50 to launch pad himself for 2028. The question I have is, how are you a governor of a state with the highest unemployment rate and the highest gas prices? How do you take that story nationally? Not sure it works.
With great difficulty. And if you don't have great hair, it would have been even harder, right? That's the thing with Gavin Newsom. Such a good-looking man.
I think even Trump agrees.
I know. Seriously. Coming up on the programme, former Commerce Department official Nazak Nikakhtar with the fate of U.S. tariff policy heading to the Supreme Court from New York City. You're watching Bloomberg TV. This price action has been so one way. A 1% move feels like a bear market to many of you, I know. Got to go all the way back to April for the last time we had a 3% drawdown on a closing basis, according to Jonathan Krinsky of BTIG. That's a long time. Equity futures this morning down by a third of 1% on the S&P. On the Nasdaq, we're down by 0.5. In the bond market, 2s, 10s and 30s, demonstrating some risk mitigation characteristics in the last 24 hours. Bond yields are lower, down again this morning by almost a basis point on 2s, Lisa, at 356.76.
Yeah, and ISM services might give further fuel to this. ISM manufacturing came in below expected. I also think that this Kava headline coming out, following in the footsteps of what we saw from Chipotle, really hammers home the point that there is a host of the economy that's lagging behind, and you're seeing it in some of the earnings. So how much does that feed into the idea that the Fed can cut interest rates more and it can fuel a more aggressive bet into treasuries?
A very defensive price action in the last 24 hours. You see that in credit as well. High yield spreads have been wider over the previous 5 sessions. Let's finish on FX and turn to foreign exchange. Switch at the border, get to euro dollar. Euro dollar coming into today negative for 5 consecutive sessions. Euro dollar this morning 114.87. Dollar strength kicking back in, Lisa. You noted this yesterday. It's been a theme over the last week.
Yeah, what, sell America, huh? Because right now we're seeing a reversal of that, and you wonder whether the flight to safety includes, once again, the flight to treasuries. Watch this space, especially as the likes of Bitcoin sell off. The idea that the momentum trade is fading, and that maybe into goes the sell America trade. That actually is reverting back as a place of a haven.
DXY around the highest since May of this year, just about unchanged on the session so far. As we count you down to the opening bell, about 3 hours away to get the equity story with your morning movers. Here's Yahara with more. Hey, Yahara.
Hi, John. AMD beat on pretty much every metric, sales, profit, you name it, yet shares are still down more than 5% now in the pre-market for failing to live up to high expectations after shares more than doubled this year. And it was the company's fourth quarter revenue forecast that was the issue. While it did beat there, it failed to hit the highest mark set by analysts. And moving on to Pinterest, those shares are also falling, plunging nearly 18% now in the pre-market after offering a disappointing holiday outlook. The company, which makes almost all of its money from advertising and is leaning heavily into AI, just isn't seeing those ad dollars coming in as quickly as investors had hoped. And another warning sign from the fast casual space, we are seeing Kava shares down 8.5% after the company cut its full year sales outlook, saying that foot traffic pretty much stalled last quarter, and it's the latest company warning of a pullback specifically among younger consumers. We heard that from Chipotle, Wingstop, and Shake Shack. So this is looking more like a trend rather than a one-off warning. John?
McDonald's up next. That's the stock to watch. That earnings report later on this morning. Yahara, thank you. More from Yahara later this hour. On our radar this morning, Democrats sweeping all 3 major elections, giving the party a much-needed boost. New York City electing Zohran Mamdani for mayor, with Abigail Spanberger and Mikey Sherrill winning their gubernatorial races in Virginia and New Jersey. Elsewhere, the U.S. government shutdown entering its 36th day, officially making it the longest in American history. Economists warning the stalemate could cut fourth quarter growth by as much as 2% if it drags on for another month. And finally, the U.S. Supreme Court hearing arguments today challenging the legality of some of President Donald Trump's tariffs. If overturned, the government may face refunding billions of dollars in a blow to the nation's finances. Lisa, this in many ways is about the bond market more than anything else.
If you don't get the $400 billion of annual revenues that we seem to be on track for from the tariffs, what does that mean for the deficit picture for some of the bond vigilantes that have gone into hiding and are covering their heads? There is this feeling that they might reassert themselves and push back against some of the recent price action. Again, it's not going to be until the end of this year that we get a ruling, maybe the beginning of next year. And by then, we might have a sense of what the cocktail of additional tariff measures might be to replace this income.
This is going to be tough for the Supreme Court. They're going to look at the U.S. Court of International Trade, and they said the U.S. Constitution makes it clear that this authority of commerce is up to Congress. And they go on to say it's not that we are not passing judgment on the wisdom or likely effectiveness of the president's policy, but just that it's not constitutional, which is why the administration is trying to make out that these are 3 big emergencies when it comes to fentanyl, the trade deficit, and having that ability to say, have a threat against China when it comes to rare earths, that they need this authority to be within the executive branch.
On the president's list of priorities this week, including what's happened in Virginia, New Jersey, and here in New York City, was this number one? Well, this hearing at the Supreme Court.
He's called it life or death for the U.S. economy, and he said in that CBS 60 Minutes interview that the economy will go to hell, his words, if IEEPA does not withstand the Supreme Court. So for him, this is paramount. But you talk to people in the administration, There are other ways they can enact tariff policy. It's just not going to be as clean. It's not going to be as blunt of an instrument, but they could still use other orders like they are using right now. They're using 232s. They're 301s. There are other instruments they can use, but it's not as easy.
Let's stay on this story. Regardless of the Supreme Court ruling, the former Commerce Department official, Nazak Nikakhtar, expecting Trump's tariffs to live on, writing the administration has several other tools that they can implement to execute their trade agenda. Nazak joins us now for more. Welcome to the programme. Let's just talk about that. What is actually at stake today if the president could just make other moves elsewhere to achieve the same means?
Well, I think the group, and it's good to be with you, the big question is this International Emergency Economic Powers Act of 1977 that allows the president to regulate imports during peacetime and take measures to address unusual and extraordinary threats. The core question is really the limitations of the president's power. Does the president have vast sweeping authority to impose tariffs in a way, regulate sort of financial aspects of the United States, or is it Congress that holds the cards there and can only delegate financial revenue raising authority to the president when it expressly says so? Those are the main questions. The Supreme Court has never heard an IEEPA case before. It's never interpreted the language. So the main question is, does this law give the president sweeping authority to regulate imports through taxes, through tariffs, which are deemed to be taxes by the judges, or is the president's authority much more restrained?
Going into this, what is your base case for how the Supreme Court will rule?
You know, it's really difficult to say. This is a very, very difficult question. You've got the major questions doctrine, which is going to be at heart of this issue, which the Supreme Court has to decide. Look, constitutional interpretation. If Congress intended to give the president vast political authority over political and economic questions, does it need to expressly state so? Think about the impact of all the other statutes. How much can the executive branch read into this, right? And right now we have three pillars of the U.S. government that are at odds with one another. The president has moved in a very unusual way to read the statute very broadly. Congress, in large part, has remained silent, even though with respect to the tariffs on Brazil, Congress has spoken up and has used its lawmaking powers to restrain the president's authority there. And now you've got the judicial branch who has to make sense of it all. And again, implications are going to be significant with this much revenue at stake.
The administration has talked about why they're using IEEPA, emergency responses to the trade deficit, to what's going on in terms of China trying to enact export controls on rare earths and then on fentanyl. Do you think one out of any of those others have more of a case in terms of an emergency authority needed to combat those issues?
Yeah, that's a great question. And this really goes back to the sort of the history of IEEPA. IEEPA has traditionally been used over the decades as really sanctions authority, right? Maximum economic pressure campaign on countries to do and not do things. So it really depends on how the U.S. government argues it. The tariffs on India, these IEEPA tariffs on India, is a maximum pressure campaign because they're buying Russian energy. We have sanctions on Russia. The IEEPA tariffs used against India feel like sanctions. They might, for the fentanyl crisis, also feel like a maximum pressure sanctions type legal authority. But if the president just doesn't like a trade deficit with a country, can he use IEEPA? I think that the courts may very likely say there's different legal authority for that. If Congress gave the president distinct legal authority to address a specific fact pattern, then can he use other legal authorities that are a little bit vague to address that same fact pattern?
Nazak, from a market's perspective, it's important to ask how much has actually changed since pre-Liberation Day. You're looking at an overall tariff rate that's gone from 2.5% to about 12.5% versus the headline figure that's somewhere closer to 20%. And a lot of some of the measures with respect to China in particular have been walked back. How much have the walls truly been put up in a way that do indicate some sort of separation of the world's two biggest economies?
This is the economic impact, at least first to the United States, right? I think partially what the president is thinking he's doing is really balancing fair trade, but then getting trade deals to bring countries closer into the United States orbit, right? and maybe this relationship with China is still up in the air. But I really want to underscore the massive economic impact. We have about $90 billion collected in the IEEPA tariffs alone. Think about the economic impact of either way that the court rules. If the court invalidates IEEPA, you've got importers, U.S. importers in large part who are paying the tariffs, but they pass through those tariffs in some significant respects to their customers. So if the court invalidates IEEPA, you've got the importers getting this massive sudden windfall of money, but then their customers aren't getting anything, will present one major shock to the economy. And if the courts uphold IEEPA, then these importers are not going to get the money that they were expecting, yet another major shock to the economy. And going back, if the court does invalidate IEEPA, now you've got importers in line to not only recover the tariffs that they paid, plus interest, because that's how this works. If you actually paid tariffs that the courts have invalidated, you're not only entitled to get the tariff revenue back, you have to get the tariff revenue back plus interest. Think about the sudden shock to the economy, depending on either way, based on how the Supreme Court rules.
What are you advising clients? Are they lining up and figuring out how exactly to request their money back from the government?
Yes and no. There's a lot of importers who are thinking about watching this very closely and figuring out how they're going to line up and what the process is, because you can't have a stampede all at once for all these importers, right? $90 billion trying to get the money back at the same time. So the courts are going to look for a process. We're looking very much into what kind of process is going to be set up for importers to get their revenue. But also we represent a lot of the businesses in the United States who've already paid those tariffs. And even if the importers of record get that revenue back, a lot of our clients, a lot of the businesses aren't going to get that revenue back because those go to the importers. And then that's a private transaction issue, whether the businesses are going to demand from their importers to get some of that back. Very unlikely, because then that becomes an accounting issue. But there's going to be a stampede, and hopefully the government figures out an orderly process, only if the Supreme Court invalidates the tariff. But look, for the Supreme Court, is this a textual issue? Is this a constitutional issue? Is it a foreign policy issue? All of this is going to really weigh how the Supreme Court looks at this.
This could get messy, that's for sure. Nazak, appreciate your time, as always. Nazak Nikakhtar there, the former Commerce Department official. Could get very messy. Policy, we wanted to move on from this. This just introduces more volatility potentially.
Yeah, and volatility we can't even really begin to imagine because we don't understand the process. We don't imagine exactly what the other measures are going to be that are going to be put on retroactively, how many companies are going to line up. I mean, the race for money and interest, who's going to oversee that? Is it going to also be Treasury Secretary Scott Bessent, who's doing everything else?
Yeah, good luck to him. Equity futures this morning, negative by 0.2%, struggling to bounce back from yesterday's losses. Let's get you an update on stories worldwide with your Bloomberg brief. With more, here's Yahara. Hey, Yahara.
Hi, John. A UPS freight jet crashed and exploded shortly after takeoff from Louisville, Kentucky. Video shows the Honolulu-bound jet struggling to get airborne with one of its engines on fire before exploding in a fireball beyond the end of the runway. 3 crew members were killed, as well as 4 people on the ground. 11 others were injured. Meanwhile, Novo Nordisk is cutting its outlook for a 4th time this year on lagging sales of its blockbuster weight loss drugs Wegovy and Ozempic. Once the leader in the space, Novo is struggling to compete with Eli Lilly in the growing market for obesity medicines. Shares of Novo Nordisk are down nearly 60% year to date. And the global sell-off in semiconductor stocks wiped out roughly $500 billion in combined market cap on Tuesday. The pullback reflects the growing investor unease over the sector's earnings potential, plus elevated stock valuations. It comes after chip makers have added trillions of dollars in market value since a low in April. That's your Bloomberg Brief. John?
Yahara, thank you. Appreciate the update. Up next on the program, Bank of America in the hot seat.
I think Bank of America under Brian Moynihan have been great risk managers, but this decade they've not been great risk takers. I expect them to have more of an opportunistic risk mindset going forward.
Up next, we'll catch up with Erika Najarian of UBS from New York City this morning. Good morning. You're watching Bloomberg TV. Later on today, the first investor day for Bank of America in more than a decade. Ahead of that, we're getting some headlines for you, some new targets. Bank of America seeing a return on tangible common equity in a range of 16 to 18% in 3 to 5 years. It's running at about 15% at the moment, so that's a lift. This is what the market's looking for. From speaking to sources familiar with the matter, Lisa, we're not moving on from Brian Moynihan's responsible growth. I think we're just putting a ton of emphasis this morning and later on today on the growth part of that. And I would call it growth with intense efficiency.
Yeah, and with some new leadership. So not only did we see Jim DeMare come over as co-president, but you did see today Bank of America announcing some new picks to lead the trading unit. So new leadership that might be more risk forward, I guess is the way to say it, as they try to seek out opportunities, not just avoid the cockroaches.
This stock has had a massive move, a move of more than 50% off the lows of April. That's quite a stunning rally into this and a change of emphasis for a lot of people in this market as well. Looking forward to the communication for the bank a little bit later, but from speaking to Brian Moynihan, Lisa, you and I over the last year or so, repeatedly talking about the potential to get a lot more out of less, to get a lot more revenue out of every single dollar. I think this is really, really important. For each additional dollar of revenue, you're going to have to spend less and less because of the staff story. That's the key part of this.
The idea that the overall business can expand, the footprint can remain the same in large part because of, guess what, AI and some of the algorithmic learning, the machine learning programs that they've put in place. They've been investing heavily in it. How can they do that in a way where they're also taking risk, extending their balance sheet in a way to compete with some of their main competitors that are doing just that?
It's something that the CFO, Alistair Borthwick, said earlier this year. We feel like we've got an opportunity to close a relative value gap, and that's what today is all about. Under surveillance this morning, Bank of America in the hot seat.
I think Bank of America under Brian Moynihan have been great risk managers, but this decade they've not been great risk takers. How they put some meat on the bones for those growth strategies will be very important. This has been a risk-off company in a risk-on year to explain the stock price. So I expect them to have more of an opportunistic risk mindset going forward.
Here's the latest this morning. Bank of America's Brian Moynihan gearing up to host its first investor day in more than a decade. Erika Najarian of UBS has a $60 price target and a buy rating on Bank of America shares. Erika joins us now for more. Erika, good morning. It's always good to catch up with you. You've got a buy rating on the stock. What are you looking to hear from Brian Moynihan and the team later on today?
So, like Mike was saying, now we have these 16 to 18% tangible ROE targets, but we really need to hear more of the meat on the bones. Now, a lot of these segments had focused on, Bank of America hasn't been taking enough risk, and that's true. But also, we want to hear about how, its thundering herd, Merrill, for example, has fallen behind Morgan Stanley. So what does it do enable to catch up? That's a naturally higher ROE business. And so really fixing that and really moving that forward is a big difference. But more than that, to be quite frank with you, Jonathan, it's more than just what they say today. What the stock has to do to continue to now lift from here and outperform peers, right? Not just catch up, but outperform peers, is to string together the kind of quarter that they just reported, right? It's going to be not just about, the show story of today, but it's about, the show and tell story of today, but it's about the execution of earnings.
Erika, you talked about this in your recent note, and I think this is a key point. From 30,000 feet, is there a credible case here to grow expenses slower than revenues? Do you see the right recipe emerging at Bank of America?
Yes, but I think that's going to require significant discipline from the top. In any large bank like Bank of America, there is always inefficient expenses. Are we keeping, senior talent too long, and are we not, pushing forward younger talent? Are we spending too much money on, offsites for ourselves rather than on clients? So I think that there is a credible case for revenues to grow faster than expenses, but management, more than it has over the past 5 years, has to be extraordinarily disciplined in terms of how, how it chooses, what expenses it chooses to grow.
How much is this the first investor day since 2011 a way of de-emphasizing Brian Moynihan and really pushing forward some new leadership?
Honestly, I don't think that's the case at all, Lisa. After all, the company had emphasized a few months ago that when they made that announcement, of those new leaders, that Brian was going to stay on through the decade. I think really the intention of this is perhaps turning a leaf over and saying, look, we're going to tell you about what comes next, what comes after responsible growth. And by the way, the investor base gets to meet JP Morgan's bench every single year. And to your point, Lisa, we haven't really met them, since 2011. And I'm sure a lot has changed since then. I think this is an opportunity for B of A to showcase the bench talent and the bench strength.
How much is some of the ambition that they have and the expanded targets predicated on the idea of a different regulatory regime where they can take more risk without getting penalized on some of the capital withholdings?
Yeah, that's a really great question. And practically speaking, the regulatory environment is going to be a tailwind in that 3 to 5 year, medium term time period that they note. However, Lisa, this is going to be about the numerator or earnings power, not the denominator. For example, the street has something like $23 billion in buybacks already for 2026. And yet the consensus return on tangible common equity for 2026 is 15% or lower than their 16 to 18% target. That means that for Bank of America to really achieve those targets, particularly at the high end, where Wells and JP Morgan essentially sit or exceed, they really need to power revenue growth faster than expenses. And that versus just optimizing the denominator or capital is really the key to share price outperformance.
Erika, you mentioned one business line and you went to Merrill. Can we talk about the credit card business as well? What are you expecting to see from that business?
That's a lot tougher. Look, Bank of America has materially underperformed its peers in card from both a growth and a spend perspective. And now you have the three card juggernauts, JP Morgan, American Express, Capital One, with big fat ROEs, which means that they can invest significantly back in those businesses, building a significant moat around their market share. And so I think that the card business, in terms of turning it around, that's going to be a tough climb because that is actually going to require a lot of expense investment up front.
Erika, this was great. It's always good to hear from you. Erika Najarian there of UBS with the buy rating on the stock. Looking ahead to that Investor Day with Bank of America. The headlines crossing just moments ago. The key one for a lot of investors, seeing a return on tangible common equity of 16 to 18% in 3 to 5 years.
Yeah, that was a significant increase. They're also talking about seeing a 30% dividend payout ratio. So really jacking that up, too, as they try to attract investors. Very curious about the details. How do they bring back some of the competition, given what a push Morgan Stanley has made, what a push we've seen from some of the biggest competitors and the inroads that they have made?
Stock is slightly softer so far this morning, down by 0.7%, but we've seen one heck of a rally off the lows of the year so far for that name and others too. Coming up on the programme, we'll catch up with Jim Zelter of Apollo, the KeyCorp CEO, Chris Gorman and Kathryn Wylde of the Partnership for New York City. From New York City this morning, good morning. You're watching Bloomberg TV.
The economic picture looks okay. Things haven't fallen apart yet.
There is some weakness under the surface. The consumer seems bifurcated.
It's not only a K-shaped economy for the consumer, it's actually also a K-shaped economy for the corporate sector.
If things get worse, the Fed will respond and cut aggressively.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
Live from New York City this morning. Good morning. For our audience worldwide, the second hour of Bloomberg Surveillance starts right now, and your scores look like this. The pullback continues, building on yesterday's losses. We're down by 0.2% on the S&P 500, negative by 0.4 on the Nasdaq 100. If you switch at the board and turn to the bond market, attracting some capital yesterday, those risk mitigation characteristics of treasuries flexed yesterday. Yields down again this morning by a basis point at the front end, 356.76. Later on this morning, a focus on the data. data, ISM services, and the big one. I never thought I'd call it the big one, but we got nothing else. So it's the biggest. ADP, a little bit later this morning.
A read on the labor market, and does it start showing the weakness that we're seeing in some of the earnings that we saw from ISM manufacturing? And the weakness that I'm talking about is consumer aversion to both eating out as well as just absorbing some of the price increases that you've seen more broadly. There is a bifurcation right now with the AI story, which is gunning ahead despite yesterday's hiccup, and the rest of the economy that we have seen in some of these earnings and some of the small caps that do indicate there is still an issue of affordability out there, and we've seen that in the political scene as well.
A few hits, Bramo, in the last week. It was Carver in the last 24 hours. It was Chipotle last week. There's a difficulty here. Costs are up, and they're struggling to pass them on. And the revenue's just not there in the same way.
And there's a bifurcation between older people, older consumers, and younger ones. The Kava CEO, this quote stood out to me. When you look at the data, whether it's consumer sentiment, Gen Z unemployment twice the national average, or headwinds facing younger consumers, there is a challenging environment. That is what we heard from Chipotle, also catering to younger consumers, where the unemployment rate is close to 10%.
Earnings just crossing for McDonald's just moments ago. Third quarter comp sales coming in at plus 3.6%. The estimate plus 3.59. An inline report from McDonald's at my first look. The stock is down by about 1.4%. But affordability in this sector is absolutely paramount. And it's paramount also at the epicenter of the politics. Lisa mentioned it, and you saw that playing out overnight.
And in the exit polls, when you look at what people were concerned about, they said they were dissatisfied with the state of the economy and the affordability. This is what Mikey Sherrill ran on in New Jersey, and this is what Abigail Spanberger ran on in Virginia. I'm not surprised that these candidates won. I'm not surprised that Prop 50 passed. What is a little bit more unexpected is the margins that these individuals won by. We're talking about plus 10 in each of these races, and this paints a difficult path for Republicans next year if the margins are this wide right now in this off-year election.
More on the politics later this hour. Coming up, we'll catch up with Jim Zelter of Apollo as valuations jitters shake up Wall Street. Chris Gorman of KeyCorp with a new wave of regional bank M&A, and Kathryn Wylde of the Partnership for New York City as NYC elects Zohran Mamdani as its new mayor. We begin this hour focused on private markets. Apollo Global Management just posted third quarter earnings that surpassed Wall Street estimates as the firm edges closer to reaching $1 trillion of assets. The Apollo president, Jim Zelter, joins us now for more. Jim, good morning.
Good morning. Always good to be here.
Congratulations. We joked when you walked in. What happens when you hit $1 trillion? Does Mark run around popping champagne? How does this work?
Well, listen, as we've said yesterday and we've said before, assets under management are just a great vote of confidence for great performance. And if you deliver for investors over time, we find ourselves the flywheel of our business is really in place, whether it was capital formation, whether it was origination. We just find that our business model is really hitting the mark right now and accelerating. And we're very happy with the quarter, but feel very good about the trajectory of the business in front of us.
There's a phrase that you and the team use, we are what we originate. Can we talk about that a little bit more?
Sure.
Your capacity to scale, can you just flesh that out, how things are tracking at the moment?
Well, they're tracking very well, but I think, if you go back to our Investor Day 6 years ago and a year ago, we really put a pin in the key attribute of success in our business. As we see the financing markets evolve, when we see the evolution of banking system, when we see the evolution of private capital, many in our industry, and we're guilty of it quite a bit. In fact, your first question, we're guilty of it. It's all about AUM. It's not about AUM. It's about your ability to really generate very strong, proprietary, scalable origination across the spectrum, whether it's investment-grade private credit or private equity transactions and everything in between. And we have taken that to heart. We've invested a tremendous amount of money in terms of our origination platforms. And I think that's what when investors come to us today on the institutional side, when sovereign funds come to us to partner, when insurance companies come to partner, yes, it's because of our investor returns, but it's because of our origination. And I just think that's the bigger story here. People want to talk about this company, that company, First Brands, Tricolor. It's been 16 years since the great GFC. The real story is the evolution of modern finance and the role that we all play. And so I think that's the thread and the theme that investors are really engaging in today. I just got back from 9 countries in 2.5 weeks, which I'm happy to talk about. And the impact around the globe of this model evolving is really the story.
We'll spend some time on that. Just for the record, you brought up First Brands and Tricolor before we did. We'll get to that in just a moment too. You want to talk about origination? Let's talk about it. Of the debt that you originated, you talked about this a bit yesterday. What was the average rating And are you able to maintain excess spread as you scale up?
Yeah, so if you look at we think about the world investment grade and non-investment grade, not private and public. And when you think about the spreads that we garnered in terms of our investment grade business, it's in the mid 300s. And we've been able to really create that spread over the last 24 months with a little degradation of 15 to 20 basis points year over year. On the non-investment grade side, it's in the mid 400s. And again, we've been able to generate that spread over the last 24 months. And again, it's not just the direct private lending, but it's all the things you do to a sponsor. So our origination footprint is about 80% investment grade, 20% non-investment grade. But really, it's the change of the model in the last 20, 30 years as a credit investor or a fixed income investor. You were an agent in the market. Whatever the origination machine wanted to deliver you, it was only price that you actually had to negotiate. And so you were an agent with really not a lot of the ability to really conduct and have the outcome. In our model, where we're the origination principal, where we actually have an impact, it allows you really to have a much greater degree of control of documentation and return and yield, and that's going to suit us well over time. So it's this principal agent issue, and we find ourselves really in the leading pack of the origination principal model versus the old model of an agent or vendor model.
And Jim, what this does is it allows you to look at a lot of documents. It allows you to look at a lot of companies. It allows you to see a broad swath of the economy, to understand exactly where the pitfalls may be. Do you find some of these arguments about cockroaches and in growing weakness in the economy credible, or are you just not seeing it in what you're reviewing, even among the things that you're rejecting?
You're 15, 16 years in a credit cycle right now in terms of the expansion since the GFC. You're going to find issues and challenges. In the last 5 to 7 years, you've had companies like SVB and First Republic Bank. And so, yes, these are clearly idiosyncratic. We're seeing a much larger theme of a strong economy. Torsten talked about it yesterday in terms of a K-shaped economy. We're seeing an administration that's very pro-business, not very regulatory friendly, want to push rates lower. And so all of those things, where you will see challenges in certain companies late in a cycle, but we are not seeing any kind of credit cycle on the horizon that's waning anytime soon. We are not seeing it.
Are you seeing a scary allocation of resources? And I say this given the fact that it has been very top-heavy to AI-related endeavors. Deutsche Bank this morning, a story in the Financial Times, looking for ways to hedge against some of their data center loans because they're worried about the overall concentration, the risk that you're seeing overnight. Yeah. Are you staying away from that?
Well, I think what you're talking about is whenever you see a massive impulse, infusion of capital into a sector, dark fiber, E&P shale in the U.S., software enterprises, and now AI in the broad ecosystem, you have to think about debt and equity returns on invested capital. And there's been a tremendous rise in valuations on the debt side, on the equity side in the last 24 months. And certainly the assumptions that you're making on the debt side as an investor and a lender to those companies, you're taking more residual risks than you did 6, 12, 18 months ago. So valuations are high. You have to be a bit more cautious. You want to be a lot more senior. You want to be secured. And so I think there's going to be a dispersion between returns between the investment grade and non-investment grade market. But that's just late cycle behavior. And when you look around the globe, as we talked about yesterday, their valuations are high. Geopolitical risks are a bit greater. And we don't see rates dramatically lower in the next 24 months. So that tells us take the risk down on subordinated credit, lean into senior investment grade opportunities.
Jim, we've seen these capex cycles throughout economic history. You've lived a few of them over a long career as well. But there's something different about this one. And you're well versed in this in a way that I'm not. Some of these assets depreciate rapidly. For you and the team, does that change how you put together some of these deals that you make?
It does. I mean, I think you're raising a really interesting point. Are we thinking, is the right way to think about a data center, utility lines and electrical lines 70, 80, 90 years ago, when day one, all you were doing is wiring the house for lights, and then you wired the house for a dishwasher, a TV, and everything else that goes with it? And how do you think about that technology, and what really is the advantage of that data center in 5, 10, 15 years with the power supply? I differentiate that with how you might finance a portfolio of chips, GPUs, that rapidly depreciate over 3 to 5 years. And they might both be in technology, but how you fund and structure both of those is very, very different. And I think that's the subtlety behind the headlines, which is going to differentiate the winners and losers, because in every industry, even the last 20 years that I just mentioned, those are all sectors that drew in a tremendous amount of capital, and you really don't know who the winner is from the debt and equity side for a few years. And so certainly with valuations as high as they are in this cycle right now, you have to take a step back and pause and say, okay, do I want to be a lender? Do I want to be an equity owner? What's the residual value assumptions that I'm making? That's really what will differentiate the winners and losers.
I'm not sure how many people are taking a step back, Lisa, at the moment.
Right now, it seems like absolutely nobody. Those debt offerings are absolutely flooding. And frankly, there is a real question about whether there's behavior that potentially isn't as prudent as what you're doing that could potentially pose some sort of risk to the rest of the market.
Well, if you think about the Mag 7, in the last 5 to 7 years, they have been a very, very small participant of the IG new issue market. In the last 2 months, there's been a handful of these companies that have been issued very, very large benchmark transactions. And again, that's not a zip code we play in and day out, but you have to wonder as a CFO, are they being very strategic about accessing that financing, and what's the long-term return of those opportunities?
Jim, you're going to stick with us, I'm happy
Sure.
to say. We've got a lot to talk about. Jim Zelter there of Apollo. Let's get you an update on stories worldwide this morning with your Bloomberg Brief. Let's cross over to Yahara for more. Hey, Yahara.
Hi, John. Self-proclaimed Democratic Socialist Zohran Mamdani was elected as the 111th mayor of New York City. Mamdani energized young voters with a campaign for a more affordable New York City. When he is sworn in on January 1st, the 34-year-old from Queens will be the youngest person to hold the office in a century. He'll also be New York's first Muslim mayor and the first person of South Asian descent. Meanwhile, the Supreme Court will hear arguments on the legality of some of President Trump's tariffs today. The court will determine whether the president can use IEEPA to impose import taxes after lower courts ruled he exceeded his authority. If the court rules against Trump, the administration won't be able to collect tariffs and may have to refund those already paid. And McDonald's reporting better than expected third quarter U.S. sales growth. The fast food chain attributing the rise mostly to higher spending per visit by customers. It's also reporting growth in its international divisions, with its CEO saying the chain is delivering sustainable growth even in a challenging environment. That's your Bloomberg Brief. John?
Yahara, thank you. Appreciate it. Up next on the program, Mamdani's New York City.
If anyone can show a nation betrayed by Donald Trump how to defeat him, it is the city that gave rise to him.
Conversation continues with Jim Zelter of Apollo up next, live from New York City this morning. Good morning. It's a pretty risk-off market in the last 24 hours. Continues this morning. We're down by 0.25% on the S&P 500, down by 0.4 on the Nasdaq 100. Under surveillance this morning, Mamdani's New York City.
New York, tonight you have delivered a mandate for change, a mandate for a new kind of politics, a mandate for a city we can afford. If anyone can show a nation betrayed by Donald Trump how to defeat him, it is the city that gave rise to him.
So here's the latest this morning. Democratic Socialist Zohran Mamdani set to become the 111th mayor of New York City, soaring to victory on the promise of affordability. Bloomberg's Miles Miller joins us now for more. Miles, first action, first job for the new mayor. What is it?
It's really to try to figure out a way to get these progressive proposals through in Albany, right? He's got to come up with that coalition and then also has to pick his team. Right now, he's on another morning show, but when he huddles with his team, he's got to come up with a transition that includes all of his coalition. It has to have people from Wall Street. It has to have people from tech, and then people from those labor centers that were critical to getting him to the office. Now, what we know is that this was one of the biggest turnouts since 1969. If you look back to that mayor's race, John Lindsay, you know what happened to him the first time he went to office on Inauguration Day? There was a transit strike. Here's hoping that that doesn't happen, but he's really got to work with these groups that got him elected in order to get this stuff done. We're talking about his very big proposals. He has a mandate for change in this city, freezing the rent, making buses free and universal childcare. All of those things need to be paid for. How that's going to happen isn't clear, but he'll have to work with business leaders, including Wall Street.
Miles, looking forward to your coverage. Thank you, sir. Miles Miller today from City Hall. With us around the table, Apollo Global Management President Jim Zelter. Jim, let's continue this. Jamie Dimon at JP Morgan has said we survived Bill de Blasio, we'll survive this. How do you and the team think about this development?
You know, we're committed. I've been in New York 40 years. I'm a committed New Yorker. The campaign is over. Now it's about the action plan. And he needs to bring people together. He needs to get a leadership team that can take on the challenges of the most complicated city in America. And if you're a New Yorker, you want to see success in this administration. The campaign's over. All the great promises, now it's about delivering. It's like when you buy a company. It's not, you don't celebrate the day you buy it. You celebrate the day you sell it in 3 to 5 years. So I think there needs to be a change in tone. And he needs to bring the city together. That's the big objective. Bring the city together and bring the best and the brightest to City Hall to work with him.
Bill Ackman said, this is an individual who spent a lot of money trying to defeat him, said, let me know what I can do. So that's the approach it sounds like Apollo is taking. What would you advise him?
Well, I think, number one, you've heard it. People think, public safety is the number one fiscal stimulus. And there's a lot of concerns about the campaign and what was said about public safety and the focus on that. So I would focus on bringing leadership together. I would focus on really making sure that the city is safe for all citizens, and then try to create a very logical engagement with all the constituents. That's day one.
That's day one. Let's talk about what's happening right now in this economy, which is what got Mamdani elected, affordability. You want to talk about the transmission of monetary policy as well. I think this is an important point. What can we do to support this economy and not exacerbate existing problems?
Torsten laid it out well yesterday. If he is right, which I believe he is, about the K economy in terms of the differentiation between those at the highest 20% and the bottom 20%, for the last 15, really since the GFC around the globe, and especially in the U.S., politicians have sort of stood back and wanted the monetary policy to solve all the problems. There is only so much that monetary policy can do. The fiscal impact of leadership, not only in the U.S., but in Western Europe, I was there last week, they really need to step up and have a plan about technology investment, employment, education, and a variety of attributes that are not really monetary policy impacts. So again, I think I'm not suggesting that we're not really focused on what the next move of the Fed are. They are critically important, but we are skeptical that even a lower impact and any kind of lower rates, it's really just going to fuel what's going on right now in the asset price frenzy, rather than having real impact on affordability and housing. Taking Fed funds down 25, 50 basis points, it doesn't solve your housing crisis. You have a national housing crisis with affordability. So I think there needs to be a massive pivot away from what monetary policy can do and how really executive leadership and fiscal policy will have a bigger impact.
Should and will are two different things. And right now it seems like the Fed is probably going to cut rates once more this year and then again several times next year, especially potentially with new leadership. Are you saying that you don't buy the argument that that's going to help the shoppers at Chipotle and the shoppers at Cava be able to afford their burritos and the Mediterranean salad bowls more efficiently, and that instead it's going to exacerbate the K and cause asset price inflation that leads to a potential threat to financial stability?
Yeah, I don't see. I got a couple of 24 and a 29-year-old. Not suggesting that their consumer attributes are going to change by what the Fed does, but I just don't see how the Fed policy of this quarter or the next 2 quarters is going to have a real impact on the accentuation of the K economy. I just don't see it. I see it much, much broader. And again, I do think, getting back to New York City, we have a portion of the economy and a portion of the demographics that is very focused on, education, jobs, employment, affordability, and I just think we got to think a much longer perspective here.
As an investor, if the Fed does cut, do you lean into the bubble? Do you say, all right, well, if you can't beat it, join it, and the idea is you've got to take more risk and get more returns?
That's not what we do. That's, there's folks who spend their day spending time about where the equity market's going this hour, this day, this week. That's just not what we do. We're much more focused on financing the global industrial renaissance, transactions we announced with Ørsted last week, or earlier this week, what we did in Europe with RWE. I was in Germany in the last 10 days. Massive global industrial capital needs. That's where we're focusing our time today. And that's what our investors want too. They want safe, robust, long duration yield. Whether the return on invested capital of XYZ data center in 15 years works, that's not what we do.
There was a headline yesterday on what you didn't do, and that was take Papa John's private. You probably don't want to talk about that directly, but can we talk about that broader business? Because Lisa mentioned Carver and what's happened with Chipotle. How tough is that business right now? How difficult are things?
I think as a principal investor in equity, in private equity and private capital, you need to think about long-term consumer trends and what's going to have an impact on various business models. And for us, we've had a real value discipline. Purchase price matters for the last 35 years. It's served us extremely well. And so, I think that you have to think about the evolution of consumer sentiment, consumer behavior, and what your impact is on different business models.
We've got about a minute left. Can we finish on what I believe is a PR battle between you and the banks at the moment? Not you directly. It just feels like everyone's trying to say the cockroaches are somewhere else. And I was listening to you yesterday. There was something that you said about it doesn't matter where the debt originates, in the asset manager or the bank. Why is that such an important point?
Because I think we've collectively lost our way. We sit on top of this amazing economy, and what we have just found is the litmus test of quality is not public or private. We've sort of have collectively lost our way. The litmus test was how good the company is and how they will perform in their business model. And again, you've got great investors in credit, you've got great banks, you've got great insurance companies. There will be a dispersion of returns over a more challenging cycle. So we're committed to open architecture. We have amazing relationships and partnerships with many, many banks, some of which are public, many of which are private. And we're going to continue that, and it really helps us our origination. But I think the longer story that gets written will really be about credit quality and the sustainability of your business, rather than something as public, private. That's not the litmus test.
Jim, it's good to see you.
Always good to be here.
Thanks for being here. Thank you, sir. Jim Zelter there of Apollo. That PR battle's been pretty clear, hasn't it, over the past few weeks?
Well, I'm smiling because, I'm sorry, with all due respect, Jim, it sounds like someone who's on top who can be conciliatory. Hey, guys, let's all get along. And the other people are like, look, this is the Jets and the Sharks. You're eating our lunch. And there is a little bit of this sort of feeling right now.
The cockroaches are over there.
Yeah, the cockroaches. They're doing something bad because they're accumulating a lot of assets.
Bank profits have been incredibly strong, and the greatest financial institutions in the world are based in the U.S.
Well said, Jim. There you go. All right. Coming up on the program, more on those financial institutions. KeyCorp Chairman and CEO Chris Gorman. As regional bank mergers gain momentum, he joins us next from New York. You're watching Bloomberg TV. The opening about 2 hours away. Your scores look like this. Equity futures on the S&P slightly negative. We're down by 0.2% on the S&P 500. Adding to yesterday's losses, likewise on the Nasdaq, the epicenter for this move in big tech. We're down by about 0.3%. That's the stock story. In the bond market, switch on the board, we look like this. 2s, 10s and 30s. The whole curve shifting lower in the last 24 hours. The move continues. 2s at 356, 10s at 4.1%. Later on this morning, some important data points. ADP for the jobs report. Look out for that. No payrolls, of course, this week. No non-farm payrolls. And then ISM services. If you want a snapshot of the broader economy right now, that's an important data point later this morning.
Especially because ISM manufacturing came in and you saw real weakness in the employment factor as well as in prices. You did not see that inflationary read-through. I'll also add to that at 1:30 today, we do get the Treasury refunding announcement too. So we get to understand how much this is not just a question of the overall economic backdrop, but also Treasury supply and how much they're moving to T-bills.
The good news I've got for you this morning is that the bond market is working. You know, it's working.
Totally.
Bonds are doing what bonds are meant to do. Equities aren't doing well and people are buying fixed income.
And guess what? It's not Bitcoin. And guess what? It's not some of these.
It's been tough, hasn't it?
It has been. And at one point, Bitcoin returns dropped below the returns of U.S. Treasury so far this year. So, the whole sort of boost of the momentum trade definitely fading back. And you are seeing things respond in a more traditional manner.
To state the obvious, November isn't April. November isn't April in the price action either. Bonds were getting sold off. The dollar was getting sold off. The dollar has been bid over the previous 5 sessions. 5 days of dollar strength against the euro this morning, pulling back just a little bit on the dollar side of things. The euro positive. Euro dollar at the moment around 114.90. As we count you down to that opening bout, let's get you some morning movers, some single names. Let's cross over to Yahira for more. Hey, Yahira.
Hi, John. McDonald's is proving its value pitch still works. Shares are now higher, up 1%. The fast food chain posting better than expected sales growth thanks to customers spending more per visit. It's a different story from what we've heard from Chipotle and Cava, which of course serve higher income diners. So it appears McDonald's efforts as restoring its reputation as an affordable option are working at a time when customers are seeking value. Meanwhile, AMD shares in the red, down nearly 4.5% now. That's despite AMD beating on pretty much everything, sales, profit, you name it, but failing to live up to the high expectations after shares more than doubled this year. And the problem was its fourth quarter revenue forecast specifically. It did beat, but failed to hit the highest mark set by analysts. And we end on the AI server maker, Super Microcomputers. Those shares are down more than 7% now after issuing another weak forecast projecting lower than expected profit and sales for the current quarter, even after trimming estimates heading into the report. John?
Yahira, thank you. Thanks for the update. More from Yahira in just a moment. On our radar this morning, Democrats sweeping the 3 major local elections by wider than expected margins. New York City electing Zohran Mamdani for mayor. New Jersey selecting Mikey Sherrill as governor. And Abigail Spanberger winning the Virginia governor's race. Elsewhere, at least 7 people are dead after a fiery UPS cargo jet crash in Louisville, Kentucky. Shocking video overnight. At least 11 people suffering injuries. The cause of the crash is under investigation. And finally, Bank of America CEO Brian Moynihan gearing up to host the bank's first investor day in more than a decade. Bank of America laying out new financial targets to raise earnings over the next several years.
Yeah, and coming out with a target tangible common equity to 16 to 18% versus the 15% currently. Also talking about ways to expand their profitability in areas like the cards, like some of the wealth management, where they haven't been able to have that Merrill Bull compete with some of the others, in particular Morgan Stanley, that have gained. Real question here, how much does this actually include AI, increasing the efficiency and some of the efficiency targets? How much does this have to do with the idea they can take more risk, given some of the regulatory regime
I think you nailed it on the AI theme. On tech, absolutely. They've made some massive investments. And from the sources I've spoken to that are familiar with this conversation, that's the story. Efficiency, Lisa. And going back to the conversations we've had repeatedly with Brian Moynihan over the last couple of years, efficiency, being able to generate additional dollars of revenue without needing to have the same level of staff to achieve it. That's an improving story.
It's not layoffs. It's lack of hiring. It's the idea that you can do more with a footprint that stays the same. And so how do they expand out? How are they deploying that? Right now, AI has been a bit of spaghetti thrown at the wall. Exactly how it's going to create profitability has been a bit of a question. How they're going to lay that out in this investor day that starts, I believe, at 9 a.m. Eastern is going to be really compelling.
Looking forward to hearing from Brian Moynihan a little bit later on that. The stock's had a great run recently. We're down just a little bit this morning by about 1%. Let's stick with the banks. Regional bank M&A activity gaining momentum with a slew of recent deals as the Trump administration eases regulation. I'm pleased to say that joining us now for a deeper conversation is the KeyCorp chairman and CEO, Chris Gorman. Chris, good morning. It's good to see you.
Good morning.
Thanks for being here. What is it with Ohio banking right now? Everyone seems to be focused on that in the regional bank space. What's it all about?
Well, it's interesting. You know, there's been a dearth of transactions for many years, and then all of a sudden there's been several. And I think there's a few reasons for that. I think, one, it used to take so long to get these deals approved that I think people were hesitant to do it. And now what we're seeing is these deals are getting approved in like 4 months, which I think after being a dearth of activity, I think you're going to see probably more consolidation in our industry. After all, there's 4,400 market participants.
Lisa, we saw this in the previous administration. There would be deals that would cross, and you and I would both turn to Annmarie, even if the deal made sense, never mind how long is this going to take. Is it even going to happen?
What is even Michael Kors? What was it? Michael Kors? Not even
entry-level luxury.
Yeah. Like,
affordable luxury.
Whatever that means. I mean, there was a real question of what's going to get across. So there's a question now of whether these are deals that have been pent up or whether these are deals that need to happen for efficiencies of scale and to compete with the big dogs, right? Do you need to actually have this consolidation?
Chris, do you feel like you need to make this happen? You need to participate?
No, we really don't. We have a great path for organic growth, which creates a ton of value. And so we're not really focused on acquisitions. We're not really focused on growing scale that way. Scale question's an interesting one. I said there were 4,400 market participants. There's only, those that are over $100 billion, there's only 30 of us. And so you have this strange market structure where you have all these market participants, but you do have a lot of consolidation at the top. The four biggest lenders have probably 25% of the assets, if you look, or 50% of the assets if you look on the top 25 banks. So we feel like, our strategy is to go out there and we always talk about targeted scale, knowing where we want to grow our business, where we win, how we win, why we win. And so our strategy is really one of organic growth.
So where are you winning? How are you winning? And why are you winning right now?
Sure. So we're focused on a couple things. We have 7 industry verticals, and where we're focused is middle market. We have this integrated corporate and investment bank focused on the middle market. So where we win is in those 7 industry verticals where we spend all of our time and where we frankly deploy all of our capital. We research these companies. That's where we win, and we win consistently.
We're talking about M&A in the banking sector, but there's been a huge wave of M&A more broadly throughout the sector, in particular middle market. And I wonder, what do you see as behind that? Is this an endorsement of credit markets, capital markets being wide open and saying, please go for it and we'll finance it? Or is this out of necessity, that in order to grapple with tariffs, in order to grapple with policy uncertainty, in order to grapple with inflation, they need to be bigger, they need to have efficiencies of scale?
I think it's all those things. And I think you've seen a lot of large deals announced just recently. The middle market is just picking up steam. And the private equity firms are sitting on about $1 trillion of dry powder. There haven't been a lot of exits. There's about 3 or 4 trillion of those probably in the backlog. And so all of a sudden, based on tariffs, based on the need to get larger, based on the need for liquidity of many of the holders of these middle market companies, we see our backlogs are at record levels right now. So I think the middle market is really going to start you'll see a lot of announcements.
How much of that is predicated on the idea that the Fed's going to be cutting rates further and that the Fed already has been reducing those benchmark interest expenses?
Yeah, I don't think, Lisa, that's what drives it. I think when the forward showed that there'd be 4 cuts or 6 cuts or 7 cuts, I think that stymied people because why not wait? But I think most everyone, it's kind of settled in, kind of a 4% 10-year. I think that you can transact, consistently there. I don't think the Fed cutting another once or twice is going to make any difference.
When it comes to bank consolidation, we're sitting here on the morning after a massive election where the margins for Democratic winners were very big. Are you concerned that all of this consolidation, deregulation, is just going to change hands in 3 years' time?
I hope not. I think from a regulatory perspective, it's not a healthy environment to have the pendulum swinging back and forth. When you're running these businesses, what you want is you don't want the politicization of regulation. What you want is consistent regulation, particularly in banking around safety and soundness. And safety and soundness really consists of 3 things. It's liquidity, capital, and earnings. And I think that's where the regulators are. So I think it'll be consistent going forward.
Is it fair to say that hope is not a strategy and there's a 3-year window now to get it done if you need to?
I don't look at it that there's a narrow window. I think, we're playing the long game. I think you have to think way ahead. You have to think 5 and 10 years ahead. And I don't think trying to jam something in some kind of window that may or may not exist, I don't think that's a good strategy.
We wanted to spend some time with you as well, tracking credit quality. We spent the last 40 minutes or so talking about it. What are you seeing with loans at the moment? Non-performing loans, net charge-offs, how are things developing?
Our credit book is in really good shape. If you look at any metrics, delinquencies, criticized, classified, if you look at our consumers have more money in their accounts today than they did pre-pandemic. Hard to believe. And we have a super prime book, but we're not seeing any cracks in the credit cycle.
Well, that's what I wanted to get to, Chris. Does that tell me more about the discipline of KeyCorp, or does it tell me something about the broader economy?
Well, I'd like to think that we are a very disciplined lender. We've always thought, we don't go out and look for assets per se. we go out and we target certain customers. We bring them into the bank, and to the extent we can help them with our balance sheet, we do. But we're not out there just trying to grow assets. I think we're very disciplined, but I also think the economy is in good shape. My personal view is that the growth of the economy is probably accelerating.
Does that include acceleration in hiring early next year? We've talked about how a lot of companies have put on hold some of their investment plans and their hiring plans to try to get more policy certainty. Do you see that coming to the fore in the first quarter? And then we'll see that reacceleration that you're talking about?
I think it depends on the industry. We, for example, have been very public. We think we've got these unique platforms. We're trying to grow our frontline folks by 10% this year. We'll continue to be in the market recruiting next year. And I do think, people do find efficiencies, though. I think one of the things that you really learn during the pandemic is that people can get pretty efficient pretty quickly. And so I'm not sure I think the labor market, my view of the labor market is, I don't think it's completely rolling over, but at least I think it's going to be relatively flat. The Fed's going to have a decision to make, I think, at some point. Do they focus on the labor market or do they focus on an economy that might be accelerating?
I'm so pleased you've gone there, and Lisa's right to bring it up. We hope we see the employment alongside the growth, but there is a question mark over that. We're trying to work out what's holding it back. So you talk about reacceleration, but you're not leaning into hiring aggressively, and we've heard that from others too. Is it technology and technological advancements that give you pause at the moment to wait to see how things develop? What is it?
Well, I think people just get more and more and more efficient. And I think people realize they can do more with less. We actually are hiring, particularly, as I mentioned, our frontline folks. But I think it's possible to have a growing economy and a relatively flat labor market. And, if you think about technology, if you think about people getting just better at really processing their business, if you think about businesses getting more focused, doing fewer things better, so I think there's a lot at play.
Chris, this was great. Super insightful. It's good to see you, sir. Thank you. The KeyCorp CEO, Chris Gorman there, really speaking to their moment in this market right now, anticipating that growth next year and the confusion at the Federal Reserve as they look at this steep drop-off in employment.
How do you deal with a dual mandate that's directly in conflict? And that is the increasing question. Of course, we don't know whether that increasing acceleration of growth is going to come with inflation. But right now, you talk to banking executives and they say things are okay. You talk to people who are in the employment market, it feels very different.
Should say steep drop-off in employment growth.
Right.
That's been the story so far this year. Let's get you an update on stories elsewhere this morning with your Bloomberg Brief. Back with us. Here's Yahara. Hey, Yahara.
Hi, John. Kava shares are lower 6% in the pre-market. The fast casual chain cut its full-year sales growth targets after seeing foot traffic stall in the third quarter. Its results mirror those of Chipotle, which shared it saw consumers pull back across all income groups. Meanwhile, BMW says demand for its new EVs is exceeding expectations. The car maker is seeing particularly strong demand in Europe while facing fierce competition in China. It warned that earnings could be hit by changes in tariff policy or Chinese export curbs on key materials. And a programming note, tune in to Bloomberg TV at 4:30 p.m. this afternoon for a live interview with the directors of Can't Look Away, the case against social media. The documentary, based on Bloomberg investigative reporting, exposes the real-world consequences of harmful algorithms. That's your Bloomberg Brief. John.
Yahara, thank you. Appreciate it. Up next on the program, a big win for the Democratic Socialist.
The working people of New York have been told by the wealthy and the well-connected that power does not belong in their hands. Tonight, against all odds, we have grasped it.
Up next, Kathryn Wylde of the Partnership for New York City. From New York City this morning, you're watching Bloomberg TV. Live from New York, welcome to the program. Here are the scores this morning, pulling back by just 0.1% on the S&P 500, erasing losses from earlier on this morning, but adding to what we saw in yesterday's price action. We're down by about 0.25% on the Nasdaq 100. Under surveillance this morning, a big win for the Democratic Socialist.
For as long as we can remember, the working people of New York have been told by the wealthy and the well-connected that power does not belong in their hands. Tonight, against all odds, We have grasped it. The future is in our hands.
So here's the latest this morning. Democratic Socialist Zohran Mamdani winning the New York City mayoral race with 50.4% of the vote. Kathryn, Wylde, CEO of the Partnership for New York City, writing the following. Ultimately, the impact of the election on business will depend on the extent to which Mamdani appoints competent deputies and commissioners to run city agencies. Kathryn joins us now for more. Kathryn, good morning.
Good morning.
Thank you for being here with us in New York City. Let's talk about some of this. What did New York just vote for?
Well, I think, number one, we have to look at the fact that more voters came out to vote for mayor than we've seen in the 56 years, since 1969, which was my first election in New York when John Lindsay was elected on the liberal line, actually. So this was a big turnout. And I think it reflects the frustration of the New York City voters with a couple of things. Number one, the high cost of living and doing business in New York City, and which Zohran Mamdani spoke very effectively to. And it reflects a frustration with a series of politicians who have disappointed New Yorkers.
Those high marks in terms of how many people came out to vote was fueled by support of Mamdani, but also those that were against him. There's a lot in the business community that have a lot of concerns. Has he assuaged those concerns yet?
I cannot say that he has assuaged those concerns completely. After the primary election, when everybody was shocked that he beat Andrew Cuomo by 13 points in that primary in June, he reached out, actually called me right away and said, tell me which business leaders I should meet with to learn from them and to show them that I'm not going to socialize their businesses.
Who did you advise he meet with?
I gave him a long list of people. I mean, our co-chairs of the partnership, Rob Spire and Albert Bourla, and Jamie Dimon, obviously, Larry Fink, leaders from across the industry, as well as the small business representatives, the Borough Chambers of Commerce, the Restaurant Hospitality Association, so a mix.
We have a lot of reporting that what business leaders wanted to see was him to tap Jessica Tisch to continue to lead the NYPD, be the commissioner there. Is it your understanding that she's going to stay?
Well, I think she's going to stay, and I will say that was the number one priority. It was an important signal both to the business community about the public safety. As employers, they want the city to be safe, and Jessie has done a great job. They just announced this week that crime is down again this month, another 6.5% on her watch. So that was a big ask. And the fact that her family is iconic in the city's Jewish community, I think, was also another important piece of that. Mamdani did say that he would retain her. I know they have spoken. And she was not going during the campaign. She was not going to make a commitment one way or the other because she doesn't think it's professional for her, in her job as police commissioner, to participate in campaigns. But I'm hopeful and optimistic that she will stay. She loves her job. She says her mission is not finished. So I'm very hopeful.
You've been in the city a long time, tracked its politics, and been a nexus between business and the political sphere. And I'm just wondering if you've seen real evidence of people leaving the city in fear of higher taxes or some sort of regime that makes it less desirable for them.
Well, people are leaving the city because of high costs in general, and taxes are part of that. And for those who think, and a big concern about our incoming mayor is that he may think that somehow spending more government money is going to make the city more affordable, when in fact it's exactly the opposite. City and state budget spending has gone up over 50% in the past decade, and that's driving our affordability crisis. So hopefully we will be successful in finding other ways to fund some of the new mayor's priorities.
Is there any evidence that that's on his docket? Because he talked about raising taxes on the wealthiest individuals. He talked about paying for it that way. Is there any sense that there is some sort of awareness of the debt and sort of the debt cycle that cities can get into that can make things less affordable?
Well, New York City has a legal debt limit. And we also, since the financial crisis of the 1970s, if the mayor gets too aggressive about his spending, a financial control board comes into place and the state takes over the city finances. So we don't have to worry about New York City going bankrupt again. So that's a check on that. In the conversations with him about the danger of raising taxes in terms of New York's competitiveness. I mean, right now, those of us professionals in New York are paying 55% of their income in taxes to federal, state, and city government. If you move to Florida or Texas, you're paying 38%. So that's a pretty big number that we have to take into consideration. So I think that he's going to become more practical as he sees the implications. He has said, I have my goals, I want to achieve them, but I'm wide open on how to do that. And that's an opening, I think, for business expertise to help him figure this out.
Well, to achieve them, he says he's going to raise taxes. But Governor Hochul says, I can't lose any more people to Palm Beach. To your point, looking at the tax differentials. So can he even attempt to raise taxes without the governor on board?
He cannot raise corporate or personal income taxes without, well, that's not a city prerogative. That is a state prerogative. He can raise real estate taxes, but he has said, as he's thought about the implications of freezing the rent, he has said he will actually do property tax reform and try and reduce taxes on rent-regulated commercial buildings, multifamily buildings. So I think that as we see who his appointments are, and how he takes input on his appointments. Last night, I was very pleased that the tax word was not mentioned in his acceptance speech as mayor, so that was a good sign. And he also started out how he's going to achieve his goals is we're going to reduce the cost of government and reduce bureaucracy. So he's sounding more and more like Mike Bloomberg.
We can only hope, Kathryn. It's good to see you. Thank you.
Thank you. Thanks
Kathryn
for having
Wylde
me.
of the Partnership for New York City. This is a pretty low bar, isn't it? The city won't go bankrupt.
I love
That's
that.
my takeaway from this conversation.
Woo, yay. I mean, it's sort of a long, big gap between where we are and bankruptcy and shades of potential pain. But look, this is the question. A lot of Zoran Mamdani's goals really are a question mark, because there are a lot of aspirations that are not achievable without getting some sort of consensus. So now the question is, to Kathy's point, who are the commissioners going to be? Who actually stays there? How much are they empowered to do what they want to do?
That's the first comparison that I've heard from anyone, Zoran and Mike Bloomberg.
Maybe it'll catch on.
Yeah, we'll see. I think a lot of New York City voters might be wanting something else, but OK. Coming up on the programme, Matt Stucky of Northwestern Mutual, plus Morgan Stanley's Michael Gapen and Matt Hornbach. Looking forward to the conversation. The third hour of Bloomberg Surveillance up next.
At the end of the day, you're not going to hit all-time highs day after day after day.
Investors should still expect that there can be some volatility.
Conditions have become increasingly fragile.
We have nice earnings growth, but it's being pushed by Mag 7.
We are going to see a broadening out of the market. I think we're heading into Goldilocks.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
It's Payrolls Wednesday. Can't get used to that. It's ridiculous.
You shouldn't get used to it.
Live from New York City this morning. Good morning, good morning. For our audience worldwide, the third hour of Bloomberg Surveillance starts right now. Your scores look like this. Losses yesterday, a little bit of follow through this morning. We're down by 0.1% on the S&P 500. On the Nasdaq, we're down by 0.2. In the bond market, a rally yesterday, this morning. 2s, 10s, 30s, pretty stable. 10s at 4.08%, 2s at 3.57. 14 minutes from now, this right here, the ADP employment report. A major focus for Wall Street, given there's not much else to focus on the jobs front.
So right now, the estimate, we don't have a whisper number because there isn't a whisper ADP number yet, but the estimate is 30,000 jobs created compared to a 32,000 decline that we saw in the prior month of the ADP employment numbers. People might be saying, are you kidding me? What are these numbers you're giving me? At the same time, as John said, this is all we have to give a read on the U.S. employment market at a time where there is a fissure. And I think that Chris Gorman of KeyBank really put it well. Right now, we could see a reacceleration of the economy without commensurate job growth. What does that do for the Fed, and how does that signal people's ability to keep on spending to fuel this, given the fact that employment isn't picking up pace?
I admire the 7 economists that put together some estimates for Friday anyway. Did you notice that?
I did not notice that.
In our survey, 7 of them actually, yeah, the median is -20. We're not going to get a number on Friday, but they've put together an estimate for us anyway.
What do you think people do without the data? I mean, think about how many people spend their day, all day, parsing through data that they no longer have. I mean, they got to find something to do, so you come up with estimates for something that's not going to come out.
Gapen of Morgan Stanley joins us in a moment. You can ask him.
Great. I'm looking forward to it.
I'm pleased you brought up that point, though. We caught up with KeyBank in a previous hour, and he's talking about an economy that's re-accelerating. So there's a regional bank. We're not talking about one of the big players on Wall Street. A regional bank saying, look, at what we see, our loan book's pretty solid right now, don't see the credit stress. And, by the way, I also expect a pickup in growth in the new year. And that's what this equity market, away from the big tech story, that's what the bulls have been looking for into 26.
Yeah, Jim Zelter kind of also talked about this real pickup in activity. Yes, we're late cycle when it comes to the credit markets, but at the same time, it doesn't seem like this economy is falling off a cliff. So it raises a question. Does the Fed need to cut? And if the Fed cuts rates, will that only exacerbate the K-shaped economy that much more? Or will it give fuel to the shoppers at Chipotle and Cava to be able to go out and spend a little bit more?
Hey, that's been a struggle. Look, it's been a problem. Cava this morning, in the last 24 hours after the bell yesterday, saw it with Chipotle last week. You are seeing a warning from these fast casual restaurants who are saying, look, this is the situation right now. Yes, of course, we've got our own problems. They never admit them. But of course, they've got them. OK, we know that with Chipotle. But if you're looking at the consumer, costs are up and we can't pass on those costs. That's a big difference. That's a major distinction between where we are now and where we were coming out of the pandemic, and why the likes of Governor Myron and Governor Wylde aren't worried about the inflation story at the moment.
McDonald's, for example, came out also this morning. They reported earnings that were pretty much in line, and yet their shares selling off. They were saying, what was the leadership? The sales, any kind of deals, something that makes people feel like they are getting value. If you take a look at Black Box Intelligence, fast food traffic is down 2.3% compared with a 1.6% drop for restaurants overall. You are seeing it among the younger cohorts and among the lower income cohorts, and that, I think, is what a lot of people are focusing on.
Cava Group this morning down by close to 7%. In the pre-market. Coming up on the programme, Matt Stucky of Northwestern Mutual as the tech sell-off continues. And Morgan Stanley's Michael Gapen joins us alongside Matt Hornbach as we break down the latest jobs data in just a moment. That data drops in about 11 minutes' time. We begin this hour with stocks lower following a sell-off in chips erasing $500 billion in value as fears of an AI bubble continue to grow. Matt Stucky of Northwestern Mutual writing the hyperscaler capex party isn't slowing down. Bond offerings were materially oversubscribed, which suggests that the market is comfortable underwriting some of this circular revenue. Matt joins us now for more. Matt, welcome to the program. I want to pick up on that point because we have seen spreads, high yield spreads, widen just a little bit. But to your point, we haven't seen mass pushback in the credit market to this theme. Is it difficult to put together a sustainable bear case, given how much the credit market seems to love what's on offer over the last week?
Look, I think it's difficult to put any kind of credible bear case in place when earnings revisions are up and to the right and they're leading the market higher, specifically in some of these hyperscalers, and the benefits are accruing to some of the providers of those capex build out areas. So, that's the NVIDIAs of the world, the AMDs of the world. Just year to date, you're looking at just a material move higher in 2026 capex estimates to the tunes of hundreds of billions of dollars. And if you're trying to be a bear in this situation, it just day after day, those numbers keep grinding higher and higher. And so if you're an analyst looking at kind of what drives equities, earnings revisions is a major input to that. And it's continuing to move in the right direction if you're in the bullish camp there.
A couple of data points building though, Matt. 3. Let's pick them out. So we had Meta last week, Palantir earlier this week, AMD overnight. What does that tell you? Their performance and how the stock has reacted to it?
I think specifically if you're looking at those companies, they all have one thing in common. It's just performance that's off the charts. And so kind of with that elevated performance profile comes elevated expectations. And so despite what I think anyone would agree or strong numbers, it just wasn't quite enough to meet that elevated expectations bar. But I think if you listen to the message during the earnings calls, the executives on those companies weren't talking about the business slowing down. In fact, they're talking about it continuing to expand at an accelerated rate. And so to me, I think this is just more of a positioning, kind of working through some of that excess performance churn as you think through about how these are likely to perform in the future.
I'm struggling to understand exactly what's driving these stocks. Is it vibes? Because ultimately the financials don't seem to be relevant when you're talking about ultimately a faith-based index. I mean, you're talking about companies that have future growth off the charts with a technological revolution that's hard to imagine that we don't understand fully how to monetize yet. So how do you know how to get involved, when to get involved for your investors?
For our clients, what we are saying is that, while it's exciting to see some of the performance in some of these names that, you can call it vibes, you can call it some of, maybe even memes, throwback to 2021. One thing that you always want to make sure of as an investor is that the fundamentals that are being reported are commensurate with the price action that you're seeing on your screen. In some cases, that's true. In other cases, it's not. Quantum computing, nuclear stocks would be probably more of, the more speculative area. But, in terms of, hyperscaler activity, order books for semiconductor companies and the results that they're generating, we would say that the fundamentals are backing up what we're seeing in terms of performance. And so that's an important delineation. And in markets, however, we are seeing some of that kind of more speculative activity being the driving force post-Liberation Day of moving markets higher. That's not to say that you aren't seeing good performance from areas where you do have that fundamental backstop in terms of stronger revenues, stronger than expected earnings, and those kind of being growth rates that are in excess of what you're seeing in the overall market.
Matt, one thing that John was pointing to earlier this morning is that it should feel pretty good to see that bonds are acting normally over the past couple of days, that as we have seen a sell-off in some of these riskier areas, you have seen the normal knee-jerk risk-off flight to safety in treasuries that you didn't see after the April 2nd Liberation Day announcement. How much does that make you feel good about the idea of bonds as a ballast and not necessarily a risk to portfolios?
I think that should give investors a lot of comfort. And we were just talking about that at a conference that we're hosting here at our headquarters this last few days, is that we're unlikely to see a repeat of what we saw in 2022, where every major asset class went down, whether it was bonds, whether it was equities. You're at a starting point in yields where the return skew is much more in your favor, just in terms of shocking rates up or down 100 basis points. And so portfolio construction does has its use again in terms of bonds providing a nice balance to portfolios. And in fact, over the last year, the total return for the Barclays Agg has actually exceeded that of Bitcoin. And so it's performing well in portfolios, being a diversifier and also generating upper single digit returns. And so that's a welcome sight for investors.
Matt, is there a tell on the back of the recent developments in crypto and Bitcoin? You mentioned Bitcoin. Is there a tell there for the broader market?
That's a really good question. I'm not the crypto guy in the office, but I would say that, if there is some speculation leaving the market that we've seen kind of burn off the last few trading sessions, areas like cryptocurrency, which, to a certain extent are somewhat of a levered NASDAQ play, are one of those areas that could come under pressure. And so maybe that's a little bit of a tell that some of the speculation needs to leave the market. But, so far, it's not something that we're really focused on in terms of portfolio construction, but it is maybe a little bit of a tell in terms of what type of environment investors are navigating today.
I'm not the crypto guy in the newsroom either. That's Matt Miller. I wish I was, based on some of the price action over the last few years. Matt, thank you, sir. Matt Stucky there of Northwestern Mutual Wealth Management. The good news is in the bond market, look, I know silver linings and all of that, some very dark grey clouds based on the price action of the last 24 hours. Let's just take stock of things. I saw these headlines about the Philadelphia Semi Index losing $400 and something billion in a session. We added 500 in 5 days. In just the last week, we've had a massive run up in that index.
This is what actually stands out to me, and I'm really glad you mentioned this, because $200 billion of that was NVIDIA, losing $200 billion of market cap in a day. And you're right, it's not that significant when you think it's a $5 trillion stock that's gone up and down $200 billion in any given day, but it highlights the potential risk given how much valuation, how much these stocks have risen if this value just gets excised from the market like that. And that, I think, is a really interesting sort of systemic question.
Once you get to $5 trillion, you should stop counting in market cap. It's like doing down points. Like, what did they lose percentage-wise? Yeah. I know these numbers sound super flashy, but they're $5 trillion names now.
Right, but I'm just wondering from an overall index perspective, it shows the disproportionate effect that they have, because that's a Disney that got erased in one day.
Yeah,
and
well
then everyone's saying, look, who cares, right? Because ultimately they are the behemoths. They are the whales in the market. So if something happens to them, how much does that undermine a broader sense of safety and growth in the market?
Stocks are just massive. NVIDIA right now down by 0.6%. Let's get you an update on stories worldwide with your Bloomberg Brief. Let's cross over to Yahira for more. Hey, Yahira.
Hi, John. Voters in California passed Proposition 50 to redraw the state's congressional map before the midterms. With 71% of the votes counted, nearly 64% of voters approved the ballot measure that could flip up to 5 Republican-held House seats to Democrats next year. Meanwhile, bad news for the kids this holiday season. Toys for Netflix's mega hit K-pop Demon Hunters will not hit shelves in time for Christmas. Retailers and toy makers were unprepared for the level of success the movie saw and will not have enough time to produce and ship the merchandise. The products are expected to hit shelves next year. And Lyft and United Airlines combining to launch a program that allows users to earn air miles on rides. Starting today, new Lyft users can receive 1,000 bonus miles just for linking their United Mileage Plus account and taking 2 rides. And if you're holding on to those airline miles, you'll be able to redeem them for Lyft rides starting in early 2026. That's your Bloomberg Brief. John?
Yahara, thank you. Thank you very much. Up next on the programme, the latest ADP employment data is just around the corner. Mike McKee's going to break that down in just a moment. From New York City, you're watching Bloomberg TV.
We're seeing a much larger theme of a strong economy. I'm not suggesting that we're not really focused on what the next move of the Fed are. I just don't see how the Fed policy of this quarter or the next 2 quarters is going to have a real impact on the accentuation of the K economy.
That was Apollo President Jim Zelter weighing in on the so-called K-shaped economy. Right now, equity futures just a little bit softer. We're down by 1/10%. That's your price action going into the opening bell. Let's get you some morning calls. First up, Morgan Stanley raising its price target on AMD to 260, citing gaming strength and data center upside. Second up, Bernstein cutting its price target on Carver to 80, saying the firm is not immune to macro pressures. Third and finally, Barclays cutting its price target on Uber to 107, saying its autonomous transition will take time. The stock is doing just about okay, positive by 1/10%. Moments ago, data dropping from ADP, the employment data crossing just a second ago. Bloomberg's Mike McKee has the latest. Good morning, Mike.
Good morning, John. The song remains the same. It looks like hiring has significantly slowed, according to ADP, and pretty much all of the data that we have watched from the alternative world. 42,000 jobs created during the month of October, according to the folks at Automated Data Processing. Most of the jobs are in the service providing area as usual, although many service providing areas did lose employment. We see a decline of 17,000 for information services, a decline of 15,000 for professional and business services, and a decline of 6,000 for leisure and hospitality. The only one really gaining, as usual, is education and healthcare services, up 26,000. And the size of businesses, small businesses, the big job generators, lose 10,000 jobs, while medium establishments lose 21,000. Large establishments with over 500 employees gained 73,000 jobs, but we've had a lot of large establishments announcing layoffs over the past week. So it is not a particularly good number. We have only 7 so far forecasts for the jobs report we're not going to get on Friday, and the consensus there was 38,000. So we're all sort of in the same range to the extent that people are even guessing, but it is still a very slow hiring environment.
Mike, I love that they're putting together estimates for data we won't get. Let's talk about the data we just got. Mike, are we just seeing just subtle signs that things have either stabilized or they're picking up? Because we heard from a bank executive about 40 minutes ago who suggested things are picking up and they're going to reaccelerate.
It doesn't look like the labor market is picking up yet. It's still kind of in a no replacement cycle at this point. We aren't seeing them necessarily falling apart, although the layoff announcements have started to come. The question is, do they continue? And is there something that's going to cause companies to hire again, or are they just still hunkered down waiting for the effects of tariffs to work their way through the economy?
Mike McKee, thank you, sir. Appreciate the update. The ADP report out just moments ago. It's an upside surprise, 42K. The median estimate in our survey was about 30K. Equity futures off the back of that, not much movement. We're still down by about 1/10% on the S&P 500. This equity market really hasn't been linked to what happens with payrolls. If it has, it's been to whether the Federal Reserve's going to cut interest rates or not, and that's kind of it. And I'm not sure this plays into the next Fed decision anyway in December.
People don't really understand the labor market and how it coheres with an economy that could be reaccelerating at the beginning of this next year, potentially on the backs of AI, but potentially also from efficiencies by companies that aren't going to lead to more employment. It's kind of a mystery. Do we need employment to really reaccelerate in order to have that strength, particularly in the consumer sectors, in places like fast casual restaurants? Or are we looking at something that is sustainable, that is just the new normal, that is more European in style than maybe the classic United States job growth?
Let's define we. Do we? Does the market need it? I mean, maybe not. Does the economy and do the politicians need it? Absolutely. And that's playing into the story of the last 24 hours, without a doubt.
The affordability, the cost of living, and how it's become completely unsustainable for a whole swath of the society. And you start thinking, if someone has assets and they can get compound interest in the market right now, they're doing great. If they don't, they cannot catch up, and the cost of living is going up really rapidly. So how do you solve this? Does a rate cut help that? Or frankly, does that hurt it more?
A year ago, President Trump came back into power because he ran on the fact that groceries are too high, gasoline is too high, and there's an inflation crisis and affordability crisis. Now what you've seen from these Democrats that have rose last night, that have swept, and I'm talking about the margins you need to look like, so I'm not really surprised that any of these people won. I am a little bit surprised about how big the margins were, plus 13 points in Virginia. They ran on affordability, electricity prices, gasoline prices, rent prices, and now this is going to be something huge the Republicans need to deal with by the midterm elections. They have 1 year to get it down.
That's their challenge for the Democrats. Can they park the woke stuff, leave behind the identity politics? Can the Green Lobby take a back seat? And can they focus almost exclusively on affordability? That's going to take massive discipline over the next few years.
It will take massive discipline, but that is what Zohran Mamdani did in this city. He talked about the rent being too high. He talked about the idea of we can have free buses. He didn't really talk about social politics. It was all about economic politics and economic policy, whether he can deliver them or not, because he has really no jurisdiction on a lot of taxes that has to do with the governor. The fact of the matter is he ran an entire campaign on affordability, not even about how Trump is someone that he can, stand up to. He didn't really talk about Trump until last night.
Let's get to the state of the economy. Bloomberg's Enda Karen joins us now from Washington, D.C. Enda, welcome. Piece it together. ADP, ISM manufacturing. For the data we have got, what kind of picture do you have?
Well, look, there's a real tension in the economy right now, John. You're either in the camp that the jobs market is weakening rapidly and the economy needs lower borrowing costs, lower interest rates, or you're in the camp that that story is being exaggerated. We need to be more concerned about inflation, and especially inflation that remains, around that 3% area above the Fed's target. And that's really where the debate is at right now, John, on the economy. And we're in this data vacuum where it's very difficult to make that call. Plenty of economists can say to you, in truth, they're not sure. I mean, you listen to the speech by Fed Governor Cook this week. She made the point in the labour market that some of it could be down to the immigration crackdown story, not necessarily a weakening jobs market. I think that's my point about both the tension and the confusion right now is, what are we facing here? Is it a slowing economy with a weakening jobs market, or is that being exaggerated, and should the focus be on inflation? And there's no clear answer on it right now.
And is there a historical corollary to this moment where we've seen an economy really expand dramatically at the same time the labor market just doesn't add that many jobs?
Well, the problem with the labour market is there are so many different factors at play. We're not sure what is going on there. And the immigration crackdown part of it is one of the main confusing points. How has the supply side impacted the monthly number? That's number one, immigration. And of course, number two, as I just mentioned earlier, we're not getting the numbers on the jobs market at the moment. So it's very hard to get a picture of what is going on there in the first instance. So it is a confusing picture. It is unprecedented in ways. And as Fed Chair Jerome Powell has made clear, by the way, it's not a good space for any central bank to be in when you have this story of persistent inflation, not runaway, but persistent, happening at the same time. There's clearly been softening in the jobs market, but no one's quite sure how weak it is. Is it stabilisation or is it something worse? And I think that part of it is quite unprecedented.
How much do these ADP numbers really shine a spotlight on ISM services that come out at 10 a.m. Eastern? The idea that we didn't see the employment component of ISM manufacturing really represent any kind of growth. Do we need to see ISM services show employment growth for people to remain optimistic that this slow churn is not unhealthy, at least?
Yeah, and you're absolutely right. There is this argument that people would say, hold on a second, we're coming from what was a very tight, by historical standards, labour market, that there was overhiring, for want of a better term, that companies are now retreating from that level. We're still not in the mass broad-scale layoff picture that some have warned about. So that argument does exist. But I think when you step back, there's no doubt when you talk about the manufacturing ISM data, that there clearly are pockets of unambiguous weakness in the economy. And manufacturing clearly has been weak for much of this year and isn't showing much signs of turning a corner, barring the whole AI CapEx side of things. And that's despite all of the political focus on regenerating manufacturing, still very much in the doldrums. So I think when people do look at what's happening across the economy, obviously pockets of clear strength, but there's clearly areas of weakness too.
Soft production, tepid demand. Seen it all year. And Karen, thank you, sir. Manufacturing's been a problem, shrinking for an 8th consecutive month. Looking at the ISM, the employment component that Lisa's talking about, 9 consecutive months of a contracting employment component in that particular reading. Not good.
I don't understand. This is supposed to be the economy that's transferring back to manufacturing to a larger degree. This is the time when we should see manufacturing picking up and taking the mantle a little bit from the services sector, given the rejiggering of the U.S. economy. We didn't see that. Do we see at least the services side of the economy firing on all cylinders?
Well, it takes months, though, even years, to bring some of these plans that some of the auto companies are talking about and other big manufacturing industries are talking about back into the United States. What struck me about ADP is the estimate range. It feels like everyone is flying by, negative 20K to plus 70K.
Just hearing from the president, weighing in on the recent elections. Let's take a listen.
Soon. But we did a great job over in China, and we've done a great job in turning off wars. We stopped 8 wars. And we have 1 to go, as you probably know, and that'll get stopped also. But we've done a great job, so it's really been an honor to do it, and I did it with many of the people in this room. Every one of you I know, and every one of you I like our leaders, I like everybody. But I thought we'd have a discussion after the press leaves about what last night represented and what we should do about it, and also about the shutdown and how that relates to last night. I think if you read the pollsters, the shutdown was a big factor, negative for the Republicans. And that was a big factor. And they say that I wasn't on the ballot was the biggest factor. But I don't know about that. But I was honored that they said that. And I just want to thank everybody for being here. And a very special thanks to Vice President J.D. Vance, who's doing a terrific job. J.D., thank you. As well as the Senate leadership team that has been working very hard, I will tell you, nobody's working any harder representing the American people, including Senator John Thune. John, thank you. Great job. Senator John Barrasso. John, thank you very much. Senator Tom Cotton, wherever you may be. Tom, thank you. Thank you, Tom. Thank you. Senator Shelley Moore Capito, who's been very involved. Thank you, Senator James Langford from one of my favorite states. 77 out of 77. I always say 77 out of 77. Reagan was 56. That was the record. We got every one of them. Thank you, James. And a fantastic friend of mine and an incredible advocate during the election a year ago, Tim Scott. Thank you, Tim. So as you know, we are in the midst of a disastrous Democrat-created government shutdown, and it is Democrat-created, but I don't think they're getting really the blame that they should. That's now officially the longest shutdown in American history. The Democrat radicals in the Senate have shown zero interest in reopening the government, and I don't think they'll act so soon. A lot of people disagree. I've been saying for the last 30 days, we've had 4 or 5 different points. Yes, sir, they're going to get it right now. We should have it done in a day. I've heard that about 4 times. I heard it after Kings. They said I was a king. And I heard it after Kings. I heard it after a couple of other moments in time. And I said, no, I don't believe so. And now I heard it's after the election. I don't believe so. I think they will. I think they're kamikaze pilots. I just got back from Japan. I talked about the kamikaze pilots. I think these guys are kamikaze. They'll take down the country if they have to. So I don't think so. Millions of Americans are going to be without SNAP benefits. And I will say about SNAP benefits, so when I was president, we had $7 billion worth, and now they have many times that, because these benefits were given to anybody that asked, and they're up to, I hear, just many times, $47 billion. So it wasn't the purpose of SNAP. That was for people that really had problems, down and out, people that really had problems. But during Biden, they gave it to anybody that wanted it. I think it's something you have to talk about because the numbers are incredible. But countless public servants are now not being paid, and the air traffic control system is under increasing strain. We must get the government back open soon, and really immediately. We have to get it up. We have the hottest economy we've ever had, and it's affecting the stock market now a little bit. But the stock market, as of Friday, has hit many record highs during the last 9 months, many. And it will again. This is just the beginning, because when these plants that are being built right now start opening up, we've never had anything like this as a boom. There's a construction boom right now, but that's going to be bigger than that. That's going to be an economic boom as soon as they open up, and it's going to be something special. We have car companies coming in. When I was in Japan, Toyota, Mr. Toyota, I said, "What's your name?" "Toyota." I said, "Oh, you're rich." I said, "How much of the company do you own?" 92.1%. I said, "I'm glad you said the one. He wants to be there." I said, "You're a rich guy." And he said, "I'm investing $10 billion in the U.S. And you know who I'm talking about, right? You introduced me, Mr. Senator. You introduced me originally when you were the ambassador to Japan. He's still
The
good.
President of the United States hosting a breakfast at the White House this morning alongside Republican senators to reflect on the events of the last night and, of course, to discuss a record-long government shutdown. I want to check in on the bond market. Bond market looks like this morning across 2s, 10s and 30s as we get some headlines on Treasury refunding. Bond yields so far higher just a little bit, 3.58 on 2s, on 10s 4.09%. With the latest, let's cross back over to Bloomberg's Mike McKee for more. Good morning, Mike.
Good morning, John. We're out with the Treasury quarterly refunding numbers. Treasury is going to auction a total of $125 billion. That is in line with estimates, and the breakdown is as follows: $25 billion in 30s, $42 billion in 10-year notes, and $58 billion in 3-year notes. Those auctions go off next week, and we shall see whether they have to increase bill sizes over the course of the quarter, because the question is, will they be borrowing enough given the fiscal trajectory of the United States? We did see on Monday's borrowing needs announcement that they lowered the amount they thought they would have to borrow this quarter and in the first quarter of next year. But $125 billion is the total, and that is pretty much as expected.
Mike McKee with the latest. Michael, thank you. As expected, Bram, maybe your take on this one.
Honestly, I think this is going to be interesting. When do they actually start to make the transition that everybody is expecting, which is more heavy issuance on the front end of the yield curve? We're not seeing it yet. People keep saying, we're going to see it, we're going to see it. Right now, it's pretty much in line, and you are not seeing that doubling down in the maturity profile of the United States debt just yet. At what point do they have to, though? I think that is what a lot of people are wondering.
And we get some bill bang next year from the Federal Reserve, right? In the next few months?
Don't call it quantitative easing.
It's not QE.
It's not QE.
Just looks kind of like QE.
It just is
not QE.
Not QE. Well, it's the idea. If you haven't caught up, it's the mortgage-related debt. The issuance that the Treasury, that the Federal Reserve is holding, they're going to let that roll off, and then they're going to buy T-bills instead. So it's a supportive aspect for the T-bill market, and maybe not so much for
a change in the composition of the balance sheet.
Exactly.
Are we calling it that? Okay.
That's
Matt Hornbach and Mike Gapen are going to break this down for us in just a moment.
Yes.
As we stick with the data, as traders look for clarity on the path ahead for rate cuts, the team at Morgan Stanley writing the following: we maintain our call for an additional 25 basis point cut in December. But the key question is what the data the Fed will actually have before December. A prolonged shutdown is a risk to our view of more consecutive cuts. Mike Gapen of Matt Hornbach of Morgan Stanley join us now for more. Gents, good to see you both. Thanks for being here.
Good morning.
Mike, I'm going to come to you first. The data, we don't have much right now.
No.
This government shutdown, it makes it less likely we get rate cuts in December. Is that right?
Well, I think we're just reflecting what Powell said, that if you're driving a car in the fog, you should slow down. So he was saying there is a case to be made where if you don't have the data, maybe you can't act. My view would be that if we're still in December and the shutdown's in play and we don't have the data, I'd be really surprised if the Fed doesn't cut. I think the drag from a government shutdown at that point could mean growth is essentially zero in the quarter. And I would be surprised if there weren't some spillovers in the limited data that we see. So I think if we don't have data, it's because the government shut down, and I think that probably still justifies a cut.
We'll get to Matt in just one second, but Michael, from the economic perspective, do you get the sense that this is an economy that needs rate cuts, especially given the fact that the slow growth, slow hire, low fire kind of churn has been going on for quite a while and may have a lot to do with other factors outside of just the trajectory of the U.S. economy?
Well, so we came into the year thinking, no, you probably don't need to cut rates this year, that you would want to ensure that any inflation rise from tariffs is transitory, and then we thought the rate cuts would come in 2026. So, my view is maybe we don't need it. There's certainly a discrepancy between the data and a tension between the activity and the labor market data, but I'm not on the committee. I don't get to make the choice. The view is the balance of risks shifted and policy needs to be recalibrated. So they've made that decision. They want to move closer to neutral. And I'm just thinking the data will justify another step in that direction in December.
Matt, are you already seeing that with respect to how the bond market is responding to recent weakness and this idea that it seems as though everyone's buying the transitory story again? They're just not saying the T word.
Well, it feels to me as if the market had to adjust its pricing for the December meeting based on what we got out of the meeting last week. But the market is also at the same time hesitant of completely taking the December meeting off of the table because I think investors are starting to look at the bigger picture. They're saying, hey, 2026 might be a better year, but we have to get through the end of 2025 first. And the government shutdown is starting to slowly creep into the mindset of investors. And they're thinking, gosh, if the data do come in on the weaker side going into the December meeting, then the Fed should very well continue its gradual move back to a neutral stance.
Day 36, longest in history. The president is now talking to Senate Republicans, saying they should just blow up the filibuster in order to do this. Is there a line in the sand where the government shutdown would need to end for you to really think that December's back on the table because all that data will start flowing through again?
Well, I think to the point that Mike made, they're going to get some data. Even if the government does stay shut down for the next couple of weeks, we might not get as much official government data as we would like to get, but we will still get a set of economic data like the data that we got this morning. We'll get another round there, and we're going to get, of course, the state unemployment claims data as well. So they're going to have something to work with. And so, to us, it's ultimately going to be the totality of whatever they have in hand that will lead them to decide what to do in December.
Mike Gapen, we've got the earnings. That's what we can go on. And we can talk to corporate executives. And we've spoken to a few already this morning. One bank executive came on the program and said things are OK, better than OK. There's no real damage in our loan book. And we expect re-acceleration into the new year. This runs counter to the view that you have on the labour market. Can you just flesh out what you do expect to see in the labour market in the months to come?
Yeah, so there's certainly a tension in the data. The activity data is solid, AI-related spending, off the charts, upper-income households doing well. You were emphasizing that in the previous segment. But the labour market data looks different. So our view is we're maybe a third of the way through the process of firms passing tariffs on to the consumer. So that's going to extend at least into the first quarter of next year. While that's happening, I think there'll be great reluctance to hire. We've seen that. The low hire, low fire labor market, the ADP report's very consistent with that. So while that's going on, we think the unemployment rate creeps higher. And we have the federal workers who took the early retirement package who will be rolling off payrolls in October to the tune of about 150,000. So we think the unemployment rate could finish this year, around 4.5, 4.6. And if that's, it's not a meaningfully higher move, that's still a very low unemployment rate, but the direction of that move, I think, is enough for a Fed chair who says he's now a little more data dependent to say, let's take another step. So modest deterioration, modest continued cooling is what we think that message will be out of the labor market.
Forgive me for referencing your old colleagues. I want to talk about Bank of America just a little bit. I want to talk about what Brian Moynihan's going to be discussing later on this morning. He's talking about less labour-intensive revenue growth. And I wonder if we need to focus on less labour-intensive GDP growth. And I just wonder what that means for the Federal Reserve. And I'm going to get to what it means for the bond market too, because I don't know if fixed income should trade on the jobs numbers or GDP. What's it going to mean for the Federal Reserve in the quarters to come?
Well, this is also part of the fog story. This rolling in is a difficult thing to understand and manage in real time. I'm not sure in the short run it changes their thinking all that much. It'll have an implication on the labor market. If it's a supply side productivity driven story, it'll also be something that brings inflation down. Right, so that it would reinforce I'll use the T word, the transitory inflation story. It would reinforce that. I think it would give you more confidence that inflation should be coming back down. And if anything, it would leave this kind of low dynamic labor market in place. I think both of those would say the Fed will have a gradual easing bias.
This has market consequences, of course.
Yes.
If you look at payrolls, there should be some kind of loose relationship between what happens with jobs and what happens with earnings. But this year, at least, we've managed to have a massive step down in jobs growth, and earnings growth has been absolutely fantastic. So equity land can ignore what happens with jobs. Can the bond market? What should the bond market trade on, jobs or GDP?
Well, the bond market typically trades on the Fed. So if the Fed is going to continue to lower its policy rate, then you would expect the bond market to trade in kind. Now, we all know that the bond market is priced for a very gradual easing of policy. The issue, though, is if the Fed delivers on what the market forwards are telling you today about the path of Fed policy, it's not as if the market forwards are just going to sit there and shrug their shoulders. They're going to move. And that's the typical behavior in the bond market. When the Fed follows the forwards don't just sit there. They keep moving in that same direction. So from our vantage point, if the Fed delivers an easing cycle in line with what Mike believes and in line with close to what the market forwards are pricing, the forwards are going to keep moving. And that's going to continue to weigh on bond yields. Already we have a 10-year yield right around 4%. We're the only house on the street that thought that would happen this year. So as the Fed continues to deliver, we do think that bond yields will continue to fall.
At what point are you starting to get more concerned about longer-term inflation and a longer-term pushback in U.S. Treasuries? I'm looking right now, Mike pointed out, Michael McKee, parsing through the auction refunding announcement, pointing out that they do plan to increase their T-bills and their low duration instruments. And there's this feeling that the Fed's going to monetize that. The Fed's going to increasingly buy that debt, call it whatever you will, in order to keep rates low while also pegging rates to a fairly low level. At what point does that pose a risk to longer-term treasuries and the potential for this to backfire in terms of some investor appetite?
Yeah, I think you're talking about the bond vigilantes that show up every now and again and typically lose money at the end of the day. You know, from my vantage point, we're going to have to see it in the data. Okay, if the Fed is lowering interest rates and inflation is moving higher, that would be the type of environment that I think would get bond investors very, very nervous. We're not really seeing that, right? We're seeing a committee that is divided on what to do in this inflationary environment. But if the inflationary environment turns out as we're forecasting, people should be very relaxed about owning high quality duration in the bond market. And by the way, just on the Treasury refunding that happened this morning, that's very much in line with our projections, not just for this refunding, but for the next several refundings. We don't believe that the U.S. Treasury is going to increase their coupon issuance until February of 2027. I mean, for all intents and purposes, that's a lifetime away, and a lot of things will happen between now and then. So we don't really see an issuance problem for the investor base and for the bond market.
Mike, I'm just wondering, what's the Fed's mandate right now? Because if the mandate is low unemployment, then right now you could make an argument that maybe it is a positive thing for them to ease. But if it's for financial stability and the idea of inflation, asset price inflation will at some point trickle into the real economy, especially in AI and energy costs and some of these other kinds of issues. How do you square whether they're potentially adding fuel to the fire?
Well, and they're risking that, right? They are taking out insurance right now against what they see as downside risk to employment. And insurance comes at a cost. And that cost is what you just mentioned, the risk of higher inflation over time, that you're a more inflation-tolerant Fed, or you fuel animal spirits in asset markets. But Powell has said many times, we do not have good choices right now. Right, so they think risks are higher to the unemployment rate, to the upside in inflation, and there are concerns about animal spirits in financial markets. So they're taking out insurance against the labor market. They're betting that the cost of that won't materialize, but that's what markets and investors are concerned about.
Matt, can we finish on the FX market? Bit of dollar strength's come back in the last 5 days. How does your medium-term view stack up with your short-term view on the US dollar?
Indeed, yeah. So we came into this year very bearish on the dollar. We held that view until last week. So given what we're seeing from the committee at this moment in time, in the absence of a full set of economic data, we decided to peel back on that view temporarily. It's a tactical adjustment in what we think will be a trend that extends into 2026. It doesn't have to play out that way. One of the things that we're debating as a House today alongside my colleagues in economics is what does 2026 and 2027 look like? That can be a game changer for the US dollar. We're still debating that. But in the meantime, if the Fed continues to cut rates, the dollar should have a little bit more room to move lower before possibly swinging higher in the second half of next year.
Good timing to back out. I'm giving you a victory lap. It's good to see you. Thanks for dropping by. Thank you, sir. Matt Hornbach there alongside Michael Gapen. Just getting two headlines from McDonald's that I want to bring to you. And it's slightly disturbing about the condition of the economy right now. McDonald's saying lower income traffic fell nearly double digits. I'll read that again. Lower income traffic fell nearly double digits, and they see the consumer pressure continuing into 2026.
This is what we continue to see from a lot of these fast casual restaurants. We saw a similar dynamic, although less severe possibly at Cava, Chipotle. The fact that McDonald's is seeing such a bifurcation with lower income consumers speaks to this K-shaped economy that everyone keeps talking about. How do you address that? We keep going back to that. Will a Fed rate cut really help that, or will it eventually just make it that much bigger?
The arc of earnings season is going to put additional focus on this story. We've moved on from big tech. We've moved on from big finance. The focus now is on this story. In 2 weeks' time, Target reports. 2 weeks tomorrow, Walmart. And that's where another spotlight's going to drop on the condition of the US consumer. Let's get you an update on stories elsewhere this morning. For your Bloomberg Brief and your News Worldwide, here's Yahira. Hey, Yahira.
Hi, John. ADP's monthly employment data shows U.S. companies added 42,000 jobs in October, coming in above the median estimate of 30,000. Of those, 33,000 were in the services sector, and the remaining 9,000 were goods-producing jobs. While the figures are tempering some concerns of a deterioration in the labor market, the modest increase still points to a general softening. Meanwhile, shares of AMD are falling nearly 2% in the pre-market. The main competitor to NVIDIA in the AI chip market failed to impress investors with its revenue forecast. The bar was high after AMD shares had more than doubled this year heading into the report. And Amazon has sent a cease and desist letter to Perplexity demanding that the search startup stop allowing its AI browser agents Comet to make purchases online for users. Amazon accuses Perplexity of committing computer fraud by failing to disclose when its AI agent is shopping on a user's behalf. Perplexity says Amazon is bullying a smaller competitor. That's your Bloomberg Brief. John?
Yahara, thank you. We'll see you in just a moment. Up next on the programme, we'll set you up for the day ahead. Plus, we'll get you some morning movers. Humana down as the company keeps its full-year guidance unchanged. That stock is down by 4%.
This was a big turnout, and I think it reflects the frustration of the New York City voters, which Zohran Mamdani spoke very effectively to. He has said, I have my goals, I want to achieve them, but I'm wide open on how to do that. And that's an opening, I think, for business expertise to help him figure this out.
That was Kathryn Wylde of the Partnership for New York City, following Zohran Mamdani's tremendous victory in the last 24 hours, becoming the mayor of New York, mayor-elect, I should say. Equity futures on the S&P 500 look like this morning. Equity futures positive by 1/10%. Likewise on the Nazak. The opening bell about 40 minutes away. So let's get you some morning movers. Let's cross back over to Yahira for more. Hey, Yahira.
Hi, John. Humana earnings just out, and shares are falling more than 4% now in the pre-market after it issued a disappointing earnings outlook. After the insurer beat profit estimates, but did not boost guidance, a move Bloomberg Intelligence called perplexing. It is also warning about rising medical costs, rising more than analysts had anticipating. So that is also hitting shares. this morning. Meanwhile, we move on to the AI server maker Supermicro Computers, now down more than 7% after issuing a disappointing earnings forecast. The CEO saying that competition remains intense, so they are cutting prices and investing more in order to win more new business. But that is hitting margins and hitting the stock this morning. And we end on Pinterest. Those shares are plunging more than 18% now in the pre-market after offering a disappointing holiday outlook. The company, which makes most of its money from ads and is leaning heavily into AI, just isn't seeing the ad dollars coming in as quickly as investors had hoped. John?
Yahara, thank you. Thanks for this morning. As we count you down to the opening bell, here's the week ahead and the day ahead at 10 a.m. Eastern Time. More data, ISM services, and the big event, a Supreme Court hearing on President Trump's tariff agenda. 1 p.m. later on this afternoon, the president delivering remarks in Miami. After the closing bell, earnings from Qualcomm. Thursday, a Bank of England rate decision and a slew of Fed speak. On Friday, heading into the weekend, you, Mitch, consumer sentiment. This morning, as I say, the main event, the Supreme Court hearing arguments over President Donald Trump's tariff agenda. Bloomberg's Tyler Kendall is standing by with more. Tyler, just hearing that Ambassador Greer will be there.
Right, exactly, John. We're also expecting the U.S. Treasury Secretary Scott Bessent, because this is, of course, a huge centerpiece of this administration's economic agenda. The court today is hearing arguments aimed at answering two questions. One, does President Trump have the legal authority to impose tariffs through IEEPA, the International Emergency Economic Powers Act? And two, if he does, can he do so without congressional approval? Because as the emergency powers stand, the president can take action against foreign nations in times of national emergencies, but the administration has never used tariffs in this way before. But this administration has. In fact, 60% of the tariffs imposed so far this term are done so through IEEPA. And our analysts at Bloomberg Economics say there are going to be big economic impacts either way. If there is a sweeping judgment against the administration, the average U.S. effective tariff rate could fall from 14.5% to 6.5%. And the White House could be on the hook for more than $140 billion in tariff refunds. Now, John, it is very clear that both sides are gearing up just in case this plays out against the administration. Take, for example, how we're seeing the White House impose other tariff authorities, such as Section 232, for those more broad-sweeping sector-specific tariffs on the basis of national security concerns.
Tyler, as the administration prepares potentially to have to go other avenues to enact their tariff policy, what do we expect them to do in the meantime? When will we get this final judgment? Can they enact those tariff policies before the Supreme Court rules?
Well, Annmarie, the fact that the Supreme Court is hearing this on an unusually aggressive schedule does signal to us that we are likely to see this issue resolved quickly, perhaps by the end of the year. Though we should note at this point, the Supreme Court has weighed in before on issues when it's an emergency basis related to the administration, but this is the first time that they're actually weighing in on the legality of one of President Trump's policies. While we wait for this to play out, we know that the administration has already pursued other tariff actions. Section 232 still waiting for some of those sector-specific tariffs to be enacted, such as those against the chip industry, but then other investigations that have been launched, including Section 301 that looks into unfair trade practices. We saw this under the first Trump administration against China around allegations of violating IP protections, for example. And the administration just launched an investigation over China's failed purchases of U.S. agricultural products under the Phase 1 trade agreement. Now, President Trump says that investigation is off, but that doesn't mean the administration isn't going to start to put forward other investigations to bolster their tariff position.
Tyler Kendall with the latest. Tyler, thank you. Tyler, we're tracking that story down in Washington, D.C. throughout this morning. In the banking world, we talk about too big to fail. In the policy world, is this too big to strike down?
Well, that's going to be a question for the Supreme Court. Are they going to be able to take that into consideration? Because ultimately, they're going to be testing the presidential authority and autonomy over the tariff structure and national security of the United States. It's a pretty big issue and sets a pretty big precedent.
This is the argument the Treasury Secretary and others have made. We're in the middle of these negotiations. We've already brought in money. You cannot strike this down. Supreme Court may then just take more of a nuanced approach. Some can stay, some have to go.
We'll be tracking that story later on today, of course. Coming up tomorrow, Seema Shah of Principal Asset Management, Bob Dole of Crossmark Global Investments will speak to the former Kansas City Fed President Esther George and Brad Rogoff of Barclays. From New York City this morning, good morning to you all. Thank you for choosing Bloomberg TV. This was Bloomberg Surveillance.
Day 4 at the WTA Finals in Riyadh.
Aryna Sabalenka had to dig deep to get past Jessica Pegula in 3 sets. The US Open champ fought back from a breakdown before closing it out 6-3 in the decider. Earlier, Coco Gauff kept her hopes of making the Final Four alive as she took out Jasmine Paolini. The American will have to beat Aryna Sabalenka on Thursday to reach the Final Four.